stride, right? So yesterday's reaction was fairly good. I mean, if you told me that we're going to be hiking capital gains and then you end flattish, wow, you would grab it with both hands. But I just want to recap and see in 2018, when at that point of time, the finance minister had introduced LTCJ again for the first time, after a while, of around 10%. On that day as well, the markets ended more or less untouched. It was more or less flattish. In the next 45 days or 35 sessions, so to call it, we had the markets correct by close to around, roughly around 10% or thereabouts. That's the kind of reaction that we saw post the budget in the next 35 sessions. By the end of the year, though, we recovered a fair bit. Now, though we are saying that in the next 35 days, there was a downtick on the Nifty, I'll tell you what, for the broader markets, there was a prolonged period of pain for the next 1 year to around 18 months or thereabouts. So the broader markets took a harder hit. This time around as well, we have taken it in our stride. But in the near term, I'll be looking at, what the index does and also the broader markets, because that's where you made the majority of the money. What about the FI flows? Well, I'll be looking at that closely as well. As Sonia mentioned, they sold yesterday and a largest chunk. And I'll be watching them because they just come back into our markets. For year to date, we have a positive number coming in for the FIs into the Indian markets. But just till last month, actually, that number was negative. So they just started turning around. And then, in fact, we have this piece of news in terms of higher taxation. So we'll be watching that. And also the other emerging markets, actually, in the last 30 days, India has got bulk of the FI flows. And the other two actually haven't got that much. What about our own FNOQs? Yesterday, there was some unwinding of positions on the Nifty Bank. Remember, some part of that will be a rollover as well, because we'll have the monthly expiry that will be playing out. But if you're looking at, the FI data points, the long positions came down by close to around 35,000 contracts, or the short contracts went up by around 20,000 contracts. And after the while, the FI short positions have moved to around 26%. Actually, the next chart will give you a better picture. The FI long positions is actually the lowest we've seen in this series. It's come down to around 2.8 lakh contracts. A few sessions ago, it was at around 3.8 lakh contracts. So the FI long positions have come down substantially. And the client short positions as well, there has been some covering out there, because that as well has come down to around 1.2 lakh contracts, which is the lowest we've seen in this series. So both of them, they have covered their positions on their respective sides. The options data, the PCR is coming back down to the lower end of the range. Yesterday, it went down to around 0.87 odd. Remember, normally it bottoms out at around 0.7. How did this happen? There was aggressive call writing, the 24,500 call, 24,600 call. Both of them added close to around 45 lakh shares out there. But what's giving you some hope is there was some writing even on the put side at around the 24,400 put. Which brings us to the levels. Yesterday's low, both on the Nifty as well as Nifty Bank, become extremely important. So that comes up for you on the screen. A reference point as well will be the 20 DMA on the Nifty, which is at around the 24,300 odd. I've given you the support levels because that's going to be more important in the near term. For the Nifty Bank, yesterday's low was at around 51,300. That's an important mark to look at. And you'll be feeling confident on the Nifty Bank once you get past the 20 DMA, which becomes a bit of a near-term resistance zone. So as of now, we ended at around the 51,800 odd mark, but those are the crucial levels that we are looking at, Sonia.
Okay, well, doesn't look like it's going to be a very good start, but let's see. We'll take it as it comes. First up on the equities front, we have lots of opinion coming through on the markets and, the post-budget situation as well. Vikas Jain of CLSA says the budget saw the government's big focus on fiscal consolidation, as FY25 fiscal deficit was budgeted at 4.9% versus 5.1% in the interim budget. And the plan to bring it down to 4.5% in FY26 was reiterated. He says with a clear focus on job generation, the government revealed a new employment subsidy which should also aid low-end discretionary consumption. He says a hike in both short-term and long-term taxes on equity is a clear negative, while the removal of inflation indexation will surely reduce investment attractiveness of premium real estate. He says no change in capex estimates versus interim budget may be a disappointment for investment-linked stocks, which have seen a large rally in the last 9 months.
Okay, this is Venugopal Garre of Bernstein, who believes that budget was a neutral event and what transpired was not entirely unexpected. He says capital gains tax increase is also a non-event. He sees Nifty at a fair value and have witnessed some heavyweight misses in recent earnings. He adds small and mid caps are rich in valuations, which should be potentially impacted as primary market fundraising accelerates. He remains selective overall and continues to have stock picks.
Okay, and let's get you some money market views. Kunal Sodhani of Shinhan Bank says the rupee dropped to a record low against the US dollar, pressured by the drop in local equities after the government proposed raising the tax rate on capital gains. He says a weak Chinese yuan also is putting some pressure on the rupee. The dollar index seems to be consolidating and awaiting the US PCE data. For the USD INR, he says 83.55 acts as a support, while 83.73 acts as an immediate resistance. And if broken, then some stops may be triggered and move towards 83.85 levels could be seen.
All right, well, those are lots of views coming in. Let's get some more. Taimur Beg is Managing Director and Chief Economist at DBS Research Group. Taimur, good to have you with us here. Thank you very much for your time. Appreciate it. So what's the verdict for the budget? Does it move the needle either which way from a financial market point of view, Taimur?
I think from a bond market point of view, it's relatively constructive. I'm not really sure about the equity market, given the points that were just raised in your earlier piece, that between the pressure on EMFX, as well as the arguably high valuation of the Indian equity markets, the long-term capital gains may well be a bit of a cold water on the financial market outlook as far as equities are concerned. But credit and bonds, in my view, are neutral to positive out of this budget. The budget is playing the long game, focus on the supply side, do things to boost productivity, both on the labor side and the capital side. And that should be good for growth. That should be good for fiscal. Key issue is, bond supply. And I think keeping the deficit below 6% of GDP was very welcome.
Taimur, hi, good morning. So you're talking about the positives, right? In terms of consumption, do you think enough was done to boost both rural and urban consumption? Because given the way taxes have been hiked, it looks like it's going to hit the middle class for sure. But do you think enough measures were taken by the government to sort of boost rural and urban consumption?
So I think if we look at the totality of the fiscal measures over the last half a decade, lots have been done to support the mid and the low end of the income spectrum in terms of welfare support. Therefore, I think that we should not expect every budget to sort of ratchet that up. Expenditure to GDP ratios have gone up. Debt GDP ratios are pretty high. We are heading into the world of higher for longer. I don't think this is the time to keep on adding fiscal outlays. I'm pleased to see that the authorities managed to pull off a fiscal arithmetic gymnastic in which no major expenditure item was really sacrificed. But I'm also pleased to see that nothing was ratcheted up substantially, because I think the bond markets worldwide, not just in India, are getting a bit stretched. So you got to be careful about the supply side. And therefore, to me, focusing on the long end of the game, just boost skills, boost productivity, that'll create jobs and income. And that's the right way of supporting the economy, not necessarily sops in the short term.
All right. Hi, Taimur. Good morning. Good to see you. When going by the fiscal prudence that the Finance Minister has stuck to, do you think India's case for a sovereign credit rating, better sovereign credit rating is on the cards? Has it made our case stronger?
Look at the credit ratings agencies. They remain a bit concerned on the primary deficit as well as the debt GDP ratio. It's going to be hard to pull off major progress in that area unless we see growth upwards of 7%. So that's my back of the envelope calculation, if you will, that for a credit rating upgrade, we would need a firm upwards above 7% forecast for GDP growth. That would help the various ratios, particularly debt service ratio, primary balance, and debt GDP. And that would then start making inroad into the spreadsheet of those credit ratings analysts, if you will, and start flashing marginally green. I think we would need those things before a proper upgrade is coming.
So there were expectations of a further expansion on things like the PLI manufacturing scheme, etc., Taimur, but none of that really showed up this time. Would you construe that as a negative?
No, I think if there were, additional incentives on top of all the incentives that has been provided so far in the last, say, 3 or 4 years, I would have seen that as a sign of worry, that it is only about industrial policy and it's only about providing incentives to the sector and protecting it. I would like the sector in manufacturing to be privy to greater competition, recognizing that there are other large manufacturers out there who are very competitive, very productive, and SOPs will not get India into the global picture of manufacturing. It would be productivity and competitiveness, and that would not be driven by SOPs. So therefore, I think that some of the incentive schemes that are in place, in my view, are plenty.
Arvind Sanger is also with us, Taimur. So let's get him into the conversation. Managing partner at Geosphere Capital. Arvind, we spoke yesterday, and good to speak with you again today. So, I was saying in the morning that the VIX sold off yesterday. The India VIX was down some 18%. Sometimes on, day zero of an event, the market reacts a certain way. And then, as things start to seep in, it starts to sour a little bit or, move the other way. Are you expecting anything dramatically different today and over the next couple of days? Because yesterday was just, absolutely flat after all those tax changes.
Well, I guess let's be clear. Taxes on stocks went up. So, we're not going to be jumping for joy for that. Let's be, honest about that. And as far as the rest of the budget is concerned, I think fiscal consolidation is happening. That is good. If they're shooting for 4.9%, that's a good sign. There are some, other than the tax increases on capital gains for equity investors, there are, minor positives, minor negatives, but I don't think there was anything barn burner either direction that should cause, any meaningful change. I think, as Tamur, I think, was saying, I think the real challenge now is the private sector has been provided a lot of incentives through the PLR scheme. It has had a tax reduction to 25% a few years ago. Profitability has improved. The CapEx cycle, the baton has to be passed on from government doing all the heavy lifting to at some point the private sector coming in. And that's going to be, this budget wasn't going to dramatically change that. I think that's what we should see in the next leg of the story as it works out. So I think the budget was largely a non-event, except for a minor negative for stock investors.
There is a negative for real estate investors as well, right? While the long-term capital gains tax on property sales was reduced, now you won't get any indexation benefits when you sell your property, which you hold for over 24 months. What does this mean in terms of whether the money will now come to the equity markets? I'm just trying to understand what the ramifications of that would be, Arvind, on a market like equities.
Yeah, well, I think, look, the financialization of assets was happening anyway. I'm not sure that there was a huge amount of investment capital going into real estate, but to the extent that at the margin it's slightly negative for real estate, it could drive some. But, I think the equity inflows are coming anyway, so I'm not sure this is going to make a big, it's going to be a big catalyst for significant incremental, because I think real estate as an investment class was anyway not, at the top of investors' incremental allocation. So I think that part shouldn't be. And I think there's one other important point that they did. They did put in a lot of incentives for job creation, which is, I think, a pretty good thing, because one of the problems is job creation, but I'm not sure that incentives alone are the solution, because I think the skilling needed and to make sure that people are trained enough for the jobs that are, going to be offered if you're trying to grow manufacturing, that's also important. So it'll be interesting to see how all of that works out. But I think, in terms of real estate versus equity investors, I'm not sure that there's enough of a thing there to get really excited about. I think the long-term story budgets are, in my opinion, small, paths on the road to what makes us bullish about India long-term.
Sonia, on real estate, right? So for older, so the indexation is gone, right? So that tax impact is larger. That is the sort of understanding. But for further sales in real estate, isn't it a booster? Because if you're an investor and you're buying something now and you sell, you're not paying 20% after 24 months. Earlier, you were paying 20%. Now you're paying 12.5%. I'm saying for future sales.
But even for future sales, you won't get indexation benefits, right?
No, but if you buy now and you sell within after 3 years, in any case the indexation is not that much. So actually, for future sales, for new projects, etc., this actually could be a booster for older legacy property which you already own, which you bought in 2000 or whatever, right? Earlier, and you're selling because property values have gone up 10x, whatever. It could be a significant hit. Tax outgo could be much higher. But for future sales, I think it could be actually a booster. We'll sort of try and understand this way.
I think, Prashant, it's case to case. For example, I was just doing the rough math for a property that my parents sold.
No, and in fact, older is good. But now, if you do it now, from now today, then
I'm saying that argument, whether it was good or bad, the change, even if you bought it in early 2000, actually depends on case to case.
Then also it could be marginal.
Exactly.
It could be marginal.
Exactly.
But from here on, I think it's not negative. It actually could be positive from a developer point of view. Taimur and Arvind, great to have both of you here. Appreciate your time. We'll take a very quick commercial break here. We are back. Our research team will get you the top stocks to watch out for that's lined up in just a bit from now.
Tax rate structure is proposed to be revised as follows: 0 to 3 lakh rupees, nil; 3 to 7 lakh rupees, 5%; 7 to 10 lakh rupees, 10%; 10 to 12 lakh rupees, 15%; 12 to 15 lakh rupees, 20%; and above 15 lakh rupees, 30%. As a result of these changes, a salaried employee in the new tax regime stands to save up to 17,500 rupees in income tax. Apart from these, I am also making some other changes as given in the annexure. As a result of these proposals, revenue of about 37,000 crore, that is 29,000 crore in direct taxes and 8,000 crore in indirect taxes, will be foregone, while revenue of about 30,000 crore rupees will be additionally mobilized. Thus, the total revenue foregone is about 7,000 crores annually. Bihar has frequently suffered from floods.
Well, it's day 2 after the union budget, and to be honest, the market is still trying to digest all that came out of the budget, especially the higher taxation that you'd have to pay on your listed shares, as well as, on things like property. But our research team is standing by to give you the list of top 10 stocks as we begin a brand new day of trade. You have so many companies that came out with their earnings, so let's get straight to that. HUL first up. Mangalam is here to tell us more. Mangalam, good morning.
Good morning. So FMCG was the sector of yesterday, could well be the sector of today as well, and that's because of HUL numbers, because in these numbers there are green shoots which are visible, probing one to ask whether the elephant is ready to dance now. What's good this time around is that the revenues have been a mild beat over street expectations, and it's the first mild beat that we've seen from HUL in the last many quarters. The EBITDA also, has seen a bit of a beat, and the home care business grew by about 5% as against street expectations of 2 to 3%. What did not do too well, beauty and wellness grew by about 3% versus 5 to 6% expectations. Food and refreshments were buoyed lower by Horlicks and Boost that were subdued performers. But volume growth of 4%, no one's complaining. Gross margins improved by 150 basis points, and personal care business as well did not fall beyond what was expected already. Management sees gradual recovery in rural demand, near zero price growth going forward, telling you that it will be only volume-led growth going forward, with EBITDA margins maintained at current levels. Their priority is to accelerate volume growth, strengthen competitiveness, and maintain healthy margins. So some aggression shown by Hindustan Unilever. See green on the stock.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Abhishek, who's here to tell us about Bajaj Finance's numbers. Morning, Abhishek.
Calculation shows that the net interest margin has declined both YOY and quarter-on-quarter. So my calculation shows that there is a 50 basis point decline in net interest margin of Bajaj Finance on a YOY basis and about 25 basis point on a sequential basis. So this net interest margin could be one of the lowest that you are seeing in the last 2-3 years or even more. So NII growth is at 24.5% YOY and about 4.4% sequentially. The other income boosted the top line growth. So net income was up 7.2% on a sequential basis. Provisions spiked up. They increased by more than 69% YOY and about 28.5% sequentially. That impacted the profitability, and profits grew by only 2.3% quarter-on-quarter. Take a look at the asset quality. The deterioration over there is very high when compared to Q1 versus Q4. This is the highest deterioration in Q1 that I am seeing for Bajaj Finance over the last 2 to 3 years. So gross NPA has increased by 8.5% in absolute absolute value. Net NPA has increased by around 11% on a sequential basis, which suggests that the PCR, the calculation shows that the PCR has declined by 100 basis points. With reference to our poll, both the NI and PAT is lower than our poll. NI by 3.9% and PAT by 1.6%. Back to you.
All right, Abhishek, thank you very much for that. More numbers, right? ICICI Pru Life also reported earnings. Yash is here with details. Yash, morning.
Morning, Prashant. So, of course, for ICICI Prudential Life Insurance, the first quarter was a mixed bag, but with a very important positive bias which came in the numbers. I'll first just make you understand the numbers with respect to our poll. New business premium has come in line with CNBC TV 18 poll. Total AP and VNB have missed estimates. Retail AP has come with a strong beat, and margin, that is the positive bias which I'm talking about, that has come in line with the estimates, and the street will be watching out for the margin number. Just to refresh the numbers in terms of year-on-year comparison, new business premium has seen a growth of 24%, total AP annualized premium equivalent growing at 34%, retail AP, which came with a beat to our poll, is growing at 57% on a year-on-year basis, VNB growing at 8%, and the margins that I was talking about, the company has been able to derive margins of 24% as compared to 30% on a year-on-year basis. But margin is the number where the industry is seen, deterioration in the margin profile because of higher ULIP sales. ICICI Prudential Life has come up with inline margins, and that's the number which the street will be looking out for. The stock has rallied about 13% in the last 1 year, 12% in the last 3 months, trading at 1.9 times price to embedded value. So because of the margin number, there's still some runway, it seems like.
Okay, well, after the announcements that came from the budget yesterday, I'm sure some spirits were needed to get people going. Mangalam is here to tell us why you should be watching United Spirits this morning. Mangalam, over to you.
Well, it was a good operational performance that came in. It was a tough quarter for, the spirits industry, the outdoor consumption industry itself. But, in that, the company posted very good performance, especially on the EBITDA front, which came in at around 458 crores versus street expectations of 405 crores as well. This, even as the revenues at 2350 crores were largely in line. That took the margins closer to that 20% mark, much ahead of the management's guidance as well. And the net profit came in at around 300 crores versus expectations of 238 crores as well. What is it that led the revenue growth? It was the premium spirits. Prestige and above, revenues grew in double digits versus expectation of 8 to 9%. And that was led by volume growth of 5.1%. Again, the street was working with a number of 4 to 5% as well. So premium products doing better and popular products not doing so well has actually aided their margin. So we have value for the popular products declining by about 2.4% and volumes declining by about 4.6% as well. And additionally, they've gone ahead and made a couple of acquisitions as well. They've announced, around 2.3 crore acquisition, 2.3 crore investment in a non-alcoholic company called Sober, and also a company called Caffeine. They bought 25% stake. Caffeine makes specialty cold brew coffee liqueur. So interesting foray out there as well. See green on United Spirits.
Okay, Mangalam, thanks for that. Well, let's move to the pharma space. Then Ekta is here to tell us about Torrent as well as Dr. Reddy is. Ekta, morning.
Morning. Well, Torrent will be reacting to its numbers today. It came out post-markets. Revenue was an inline set of numbers. So revenue was up around 10-odd%. Margins 31.6%. Street was anticipating 31.4%. And profit at 457 crores versus our poll of 458 odd crores. Now, adjusted for one-off expenses, the margins came in at around 32.3% as per the company. Now, India did well. It was up 15%. Their chronic business, in fact, outperformed the market with a growth of 14%. Germany did well. It was up around 10-odd%. US continues to be sluggish. It was 31 million versus 32 million Q-on-Q and versus estimates of 35 million. But they have indicated that there could be a pickup in the coming quarters in the US business, aided by 6 to 7 launches. So I expect Torrent Pharma to be in the green today on the back of their numbers. Dr. Reddy's will be in focus because on the 27th of July is when they will be meeting for their Q1 numbers. They will also be considering a stock split.
Okay, all right. Thanks a lot for that, Ekta. Well, I'm keeping an eye out on Vedanta. Yesterday, the stock actually was lower, but that was more to do with the global weakness that we saw in base metal prices. For the time being, the stock's in focus because the board will be meeting on July 26th for the second interim budget. The record date as well has been fixed as August 3rd. Now, a couple of alerts out there. They've already paid one dividend of close to around 11 rupees. That was in May 2024. And they're sitting on a good amount of liquidity because they've got 8,500 crores by the QIP route. So keep an eye out on the stock. Fundamentally as well, the stock is well placed, but prices, LME prices, need to be tracked. Well, let's go back to Abhishek. He's here to tell us about Mahindra & Mahindra Financial. The numbers came during market hours, but there were con call takeaways as well. Abhishek.
M&M Finance did report their P&L during market hours. However, the finer details came out in the presentation post-market, wherein the net interest margin looks to be the lowest in many quarters. It has come in at 6.6% versus 6.8% YOY, and compared to 7.1% for the previous fiscal that they had, FY24. Now, I am saying previous fiscal because they give cumulative net interest margin, that is Q1, H1, 9 months, and then fiscal. So there is a sharp decline in their net interest margin, and P&L is below pole. The NI is at 1,894 crore versus 1,910 crore of our pole, and the PAT has come in at 513 crore. We were working with a number of 520 crore. Another finer detail was with respect to the absolute value of gross NPA. Gross NPA in Q1 increased by 8.6% quarter-on-quarter, and net NPA increased by 18.5% quarter-on-quarter. So there is a sharp deterioration, unlike what you have seen in other few years. This is the highest gross NPA and net NPA deterioration that we have seen in Q1 of a fiscal. So PCR has declined. Provision coverage ratio, as per my calculation, is below 60% versus 63% in the previous quarter. Management has reiterated that they will maintain their credit cost at around 1.4%, and on the higher side, they will try and maintain the ROA of 2.2%. So if at all, I spoke to some analysts, they said if at all asset quality deteriorates, PCR of the entity could fall further. Back to you.
All right, Abhishek, thanks very much for that. So that's M&M Financial, which will also be reacting to earnings. Parag Milk is the other one we want to focus on. Mangalam is here with details on this one. Mangalam.
Well, after United Spirits results, everyone would say, Daru, what about Doodh? Doodh's doing actually a lot better because, the margin expansion for the dairy sector continues. If you look at Hatsun Agro, Dodla Dairy, Parag, all of them seeing gross margin expansion anywhere between 400 to 550 basis points, and that's reflected in Parag's numbers as well. The EBITDA is up 32% at a time, and the revenues are up just about 1.1%. Margins improving from 5.6% to 7.4%, and net profit up by 28% as well. They reported a 10% overall volume growth, and in that as well, premiumization has been working. Ghee, cheese, and all their new age businesses, which is protein and value-added milk, etc., growing between the tune of 15, 12, and 51% as well. All these things working for them, along with reducing milk procurement prices as well. So, same time last year, milk was procured by them at around 38 rupees per litre, now down to 31 rupees, which is a decline both quarter-on-quarter and year-on-year. This is a positive, especially because last quarter there was a mild blip in milk procurement prices, making people wonder if the dairy cycle is turning, but turns out that not yet, it is still positive.
Okay, Mangalam, thanks for that. Well, let's go to Vamakshi and wind this down with Shuffler India. Vamakshi, morning.
Well, good morning, Nigel. A good set of numbers is what the company has reported this time around. Revenue saw an uptick of almost 15% on a YOY basis, and this has come in higher than what analysts were expecting. And this growth in revenue is largely being led by bearings and industrial solutions, as well as vehicle lifetime solutions, both of which were up nearly 18%. But the cost of goods sold were much higher as compared to the revenues, growing by almost 17%, and resultantly we saw a contraction of nearly 90 basis points in the gross profit margins, and gross profit was up nearly 13%. EBITDA came in higher than what the street was expecting, growing by almost 10% YOY, and the margins, however, saw a contraction of nearly 84 basis points. Net profit, however, came in line with what the street was expecting, nearly 3% higher. Overall, it looks like a good set of numbers with revenue EBITDA above estimates, EBITDA margin slightly below, but the net profit is in line with what the street was expecting, and resultantly I expect the stock to open higher today.
Okay, thanks a lot for that. So those are some stocks to watch out for. But let's also find out what's happening in the world of commodities, because clearly there's a lot happening over there. Oil prices have been rising as US crude and fuel inventories are seen shrinking. So Manisha Gupta is here to give us the latest on that. Manisha, over to you.
Thank you for that, Sonia. Well, yes, some bit of an increase in crude oil prices, but it's not so much. It still is trading around that 1 month lows. And if you look at the crude products, heating oil is at a 7-week lows, gasoline at a 1 month lows. The markets are reacting to the US decline in inventories. But apart from that, the street does believe that with the Israel and Hamas ceasefire talks gaining momentum, that pressure could continue into the market. If you look at the last 1 week itself, the crude oil prices are down by 3.5%. It has been a huge pressure that we've seen in the metal prices as well. The gold and silver prices, while in the international markets, fell by 0.5%, but the Indian market saw a reaction to the duty being slashed. So we've seen 5% of a decline overnight in the Indian gold and silver prices. The base metal prices also have been taking it quite strongly. 3-month lows on copper. We've seen another 2% of decline onto this one. Iron ore prices are trading at a 1-month lows, aluminum at a 2-month lows. So the strength in US dollar and, of course, the rising inventories, weak economic data from China, all of that has continued to weigh in for the metal prices. So after a weak June, the July seems to be going on the same set.
Okay, all right, Manija, thank you very much for that. So that's what's happening as far as commodities are concerned. We'll take a quick commercial break here. On the other side, we'll have one of the biggest money managers in the country, S. Naren, Chief Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company, will be joining in to discuss what to make of the budget announcements and markets from here. Stay tuned.
Originating outside the country. Plans to build flood control structures in Nepal are yet to progress. Our government, through the Accelerated Irrigation Benefit Program and other sources, will provide financial support for projects with estimated cost of 11,500 crore rupees, such as the Kosi-Michi intra-state link, and 20 other ongoing and new schemes, including barrages, river pollution abatement, and irrigation projects. In addition, survey and investigation of Kosi-related flood mitigation and irrigation projects will be undertaken. Assam grapples with floods every year by the Brahmaputra River and its tributaries originating outside India. We will provide assistance to Assam for flood management and related projects. Himachal Pradesh suffered extensive losses due to floods last year. Our government will provide assistance to the state for reconstruction and rehabilitation through multilateral development assistance. Uttarakhand too suffered losses due to cloudbursts and massive landslides. We will provide assistance to the state. Recently, Sikkim witnessed devastating flash floods and landslides that wreaked havoc across the state. Our government will provide assistance to the state. Andhra Pradesh Reorganization Act. Our government has made concerted efforts to fulfill the commitments in Andhra Pradesh Reorganization Act.
All right, welcome back. We're sort of counting down to the pre-open session. S. Naren is one of India's biggest fund managers. He's Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company. Naren, great to have you with us here. Thank you very much for your time. Prashant this side. I'm going to come to you. I just want to quickly play out this soundbite, and I want you to listen to this as well, because my first question is going to be that. This is Finance Secretary T.V. Somanathan on the revision in the taxation to 12.5% and 20%, and whether there'll be more coming in the next 6 months, that is the next budget in February. Listen in.
88% of the value of capital gains earned in India, according to our study, comes from people whose returned income is more than 15 lakh rupees. And 62% comes from those who are above 1 crore of returned income. So this is not a tax which is falling predominantly on the not at all.
Class,
and this is the class of income which Thomas Piketty and others have been writing about all the time. Now, at some point,
it then begs the question: are you looking at a higher rate? Because that's the worry, that you've done 12.5. This is perhaps an odd rate.
If we were looking at a higher rate, we would have done it.
But
Why
maybe
would we not do it?
maybe you're testing waters with 12 and a half,
No,
and
we
maybe
don't
you'll,
believe in testing waters.
So is it going to be 12 and a half now for the near term? I mean, for the next few years?
There is no intention to revise it from here. I cannot speak for all the future finance ministers and finance secretaries, but I can say as of now, we have no intention of revising this any further.
So 12 and a half is...
Of course, no one can predict the future.
No, absolutely.
Somebody else may cut it too. I can't predict that. But what I am saying is we need equity in taxation. We can't say that only equity markets take risks and a person doing an MSME business is not taking risk and he should pay 39%. And because I'm taking stock market risk, I should not even pay 12.5%. There is a case for a lower rate on capital gains tax. It is much, much lower than the marginal rate of tax on other sources of income. And it's creating distortion in the savings markets also.
Naren, thanks for listening into that. So the assurance that it's going to be 12.5, not more. So I want you to react to that first before we get into markets, etc.
I think basically the markets can absorb it. That's why you would have seen yesterday that the market basically closed almost flat. And so from that point of view, I would say markets can absorb, equity markets have the capability to absorb at this point of time, given the kind of inflows that the market is seeing at this point of time. So I don't think there is a problem in equity markets because of a taxation increase. If the problem was there, we would have noticed it yesterday at this point.
And so it's done and dusted, right? Behind. It's not as if there is some any lingering impact from here.
It's not that. See, we have to recognize where we are in the markets. We are in a market at this point of time where valuations are high, sentiment is exuberant, macroeconomics is fantastic. So and India is one of the best structural stories in the world for the next few decades. So the combination makes it very complicated because do people look at the next few decades of structural growth and say, let's pay up for it? Or say India is one of the best macro in the world? Or people say valuations are so high compared to the rest of the world that you have to be cautious. Which of these things do you look at? It's a very difficult problem, particularly for a global investor. From a domestic investor point of view, people, I think, are not investing in debt at this point of time because they're looking at the remaining two and saying that let's look for the long term. So that's why the government has done something more interesting outside equity, which is bring down the price of gold substantially, reduce the capital gains tax on real estate. So, we are not experts in these asset classes, but how do people react to that? How do people react to a big drop in customs duty and gold and drop in capital gains tax on real estate without indexation? It beats me. I'm not able to understand because yesterday real estate stocks were down because capital gains tax on real estate was down without indexation. So this is something which maybe I can't...
Naren, so we were just discussing that before you came on real estate. Is it for legacy old property, this is negative? I mean, if you bought something very cheap 20, 30 years ago and now you're going to pay it this tax without indexation. But for new property sales, isn't this, even if you buy something now and you sell after 24 months, you pay 12.5, not 20. Even if you bought at that point without the intention to sell, in theory, the taxation is now much lower. So from a stocks perspective, isn't it positive?
Yeah, even forget from a stock point of view. Today, for example, if I invest in a 2 years in our liquid fund or money market fund, you are in the top tax rate, you end up paying more than 33 or 38%. Whereas you invest in a property and sell after 2 years, you're going to pay 12.5%. There's a huge difference in taxation between investing in real estate and investing in debt mutual fund today. Is that something which is logical at this point of time, that debt mutual funds are the most hated asset class at this point of time? So I think slowly over a period of time, the government is saying do not invest in debt and invest in property, invest in equity, invest in these kind of asset classes, and that is what may happen because slowly over a period of time, debt has become the only asset class where you are charged at the marginal tax rate whereas both in property and equity, you get very, very favorable tax treatment at this point of time. So is that
Naren,
I don't
got
know.
that, yes. Got that. Hi, good morning. This is Sonia here. I was going through a piece that you had put out where you mentioned that now you're starting to get a bit cautious on the mid and small cap space. And across the board, you are seeing a bit of fair valuation, slightly higher above fair valuations for the broader market. So what does one do now? If you get a dip in the market, do you think the best way to approach it is to stick to large caps and perhaps churn out of mid and small caps?
So actually, for the last 1 year, we've been cautious on small and mid caps. But small and mid caps have kept going up. And, it reminds me of the period, we used to always come on TV and say FMCG, we are cautious. And FMCG used to continue to outperform. Then we have had a 3-year run between 2020 and 23 where FMCG underperformed the market 100%. So we seem to be into one of those phases where we continue to be cautious on small and mid caps, but small and mid caps keep going up. But what happens is, what we've seen is when you have these accumulated underperformance of overvaluation, it shows up later. And when it shows up, you don't know. No one knows. But we are believers in asset allocation first. Then we are believers in flexi cap and large cap. That's how we look at it. Doesn't mean that today onwards, small and mid cap starts underperforming. The more it outperforms at this point of time, just like what happened in real estate between 2013 and 2020, or in consumer stocks between 2020 and a few months back, you can have long period of underperformance after the overvaluation. And we are not astrologers to know when the top of this FMCG or top of real estate will happen. If we knew, I would tell you, but I don't know.
All right. Hi, Naren. Good morning. Good to hear your thoughts and always good to see you in. Tell us your thought process now on some of these value buys. Energy fund has raised a fair bit of money. Stocks like NDPC, ONGC in the past have been quite positive on. What's the thought process from here on?
Finally, at the end of the day, there are three things we depend on. We are dependent on moving from one place to another. So we need energy. Without power, we can't do this. Without telecom, we can't do this. See, we are always believers in this, but even these three sectors are not cheap. So the public has given us a lot of money to manage and given us a tough, responsible job on how to handle this market, because I wish these stocks were cheaper. So we'll have to handle this fund with the care that it deserves, given that public has given us the money. So it's a tough job. The challenge in the mutual fund industry is, 4 years back when the stocks were cheaper, we had to defend our investment in these stocks. Today, when the stocks are costlier, people have poured money and given us. So that is a tough job that we have, and how to handle public money in this area is one of the tougher jobs. But markets across the board are not cheap at this point of time. And we have a tough job grappling with all the money that we have and have to manage on an incremental basis. That is why we tell people be defensive, follow asset allocation, and that's the way to go. And it has nothing to do with the budget. I think it's a super budget. They have done exactly what is needed at this point of time, because in all areas where things can be borne, they have increased taxation. But there is no way in which you can have a situation where it means that markets are cheap at this point.
Okay.
All right, Naren, we need to take a break. But before we do that, I just want to quickly understand your asset allocation strategy. As you said, there's been some tinkering in taxes for equity, but the other asset classes as well, there's been some tinkering in gold as well as real estate. And asset allocation is going to be key. So what would your strategy be as of now?
So clearly, one should follow. In between, we used to think gold had gone up too much. Now, with this big drop in customs duty, gold prices in India have crashed. So what happens is, again, multi-asset kind of strategies become very, very interesting because of the drop in gold and silver following yesterday's sensible drop in customs duty. So I would say multi-asset kind of strategies are the par for the course at this point of time for long-term investing, where you do not put all your eggs in the equity basket alone and bet on all the asset classes at this point.
You want to give us a weightage for each of these asset classes if you're deploying fresh money?
These kind of things can't be done. It depends on individuals' capability. There is no such model which exists where you can apply one size fit models.
Absolutely. I know it. I mean, mornings are busy, Naren. Just requesting you to stay with us for a bit longer. We have to take a break, very quick commercial break, but see you on the other side with S. Naren.
Recognizing the state's need for the capital, recognizing the state's need for a capital, we will facilitate special financial support through multilateral development agencies. In the current financial year, 15,000 crore rupees will be arranged with additional amounts in future years. Our government is fully committed to financing and early completion of the Polavaram irrigation project, which is the lifeline for Andhra Pradesh and its farmers. This will facilitate our country's food security as well. Under the Act, Andhra Pradesh Reorganization Act, for promoting industrial development, funds will be provided for essential infrastructure such as water, power, railways, and roads in Kopparthi node on the Visakhapatnam-Chennai Industrial Corridor and Varavakal node on the Hyderabad-Bengaluru Industrial Corridor. Government will implement following 3 schemes for employment-linked incentive as part of the Prime Minister's package. These will be based on enrollment in the EPFO and focus on recognition of first-time employees and support to employees and employers. Scheme A, first-timers. This scheme will...
Okay, welcome back. There's 7 minutes to go for the market open. Naren is still with us. Naren, thanks for waiting. I just want to sort of press upon the debt mutual fund aspect just one bit longer, because I mean you've been kind of championing how debt has been ignored as an asset class. Everyone is piling into equities, and now you got this, as you also said. You said, well, the indication seems to be from the government that don't invest in debt. Invest in gold, real estate, maybe stocks, of course, with higher tax even, but debt, it becomes very unattractive in that sense. Would you agree, Naren? And would you see shifts in terms of flows from investors?
I don't know. I think inadvertently this seems to have happened at this point of time. I don't know what is the situation, I think, but I don't think it was a planned thing. But government, whether it's a government, what's happened, it's very difficult. But right now, for us, for example, we are not able to convince any of our investors to invest in debt mutual funds. They are very, very equity focused at this point of time. That's what we're seeing at this point of time. So, but what we have seen over a period of time is debt plays a very important role in every person's asset allocation. So instead of focusing on debt, we have to think of getting them into asset allocation strategies or hybrid strategies at this point of time. And that is what we try to get people to do at this point of time. And
convincing them now is going to be even more difficult.
No, it's not that. See, our view is, basically, there has to be a bit more volatility in Indian equity. If there is no volatility in Indian equity, people think that why look at debt, the day we see it, we've got 10, 11 years, thanks to fantastic macro management by the government of India and Reserve Bank of India. What has happened is we have not seen much of, movement of markets downwards. So you have not had a down year for so many years in equity. So people have come around to this view that equity is a safe asset class without a risk of a downward move. I think the year there is a downward move, I think that will come back. That is how we look at it. But right now,
got it. Just one more. I just want to press this in. Rural allocation from the government. I take your point on the volatility bit. Rural allocation for the rural sector is down once again. I think it's down for the last 5 years. Every year it's down. So there was some expectation that at a mass level, rural, etc., there'll be that support from the government. It's not happened at all. Just your thoughts on any bets that people have been making and any implications for stocks.
I'm not an expert, because if you look at the way MNREGA allocations have been going up and a lot of indirect things that are happening, for example, most of the road construction that happens through the highway programs in various ways, even the expressways happen in rural areas. So how you count the rural allocation is a bit of this thing. If you look at the way, if you talk to most of the construction companies, they tell you it's so difficult to get labor at this point of time. So, I mean, it's very difficult to correctly predict what is the amount of money which goes to rural area directly and how much goes indirectly. So I think it's not fair to the government to say rural allocation is not there. It goes through direct channels and it goes through indirect channels. And that is how we see it. And maybe that is just looking at just some rural indicator alone is not the way to look at it.
No, I completely take your point, direct and indirect. But the printed number is what I'm going with. So that is down. That's what I meant. Naren would have sort of lots of other points to discuss, but we are completely out of time. And you have a very busy morning as well. So thank you very much for being with us here on CNBC TV 18. Thanks for your time here.
Thank you.
As always. And good chat. We'll take a quick commercial break here. We're back with a pre-open session. We'll also be joined by Mitesh and Sudarshan, trading ideas from here. That's coming up.
Month wage to all persons newly entering the workforce in all formal sectors. Direct benefit transfer of 1 month's salary in 3 installments to first-time employees, as registered in the EPFO, will be up to 15,000 rupees. The eligibility limit will be a salary of 1 lakh per month. The scheme is expected to benefit 210 lakh youths. Scheme B, job creation in manufacturing. This scheme will incentivize additional employment in the manufacturing sector linked to the employment of first-time employees. An incentive will be provided at specified scale directly both to the employee and the employer with respect to the EPFO contribution in the first 4 years of employment. The scheme is expected to benefit 30 lakh youth entering employment and their employers. Scheme C, support to employers. All additional employment within a salary of 1 lakh rupee per month will be counted. The government will reimburse to employers up to 3,000 rupees per month for 2 years towards the EPFO contribution for each additional employee. The scheme is expected to incentivize additional employment of 50 lakh persons.
As I've been saying, the standout feature of the upcoming budget is that the government has more money than it expected in the interim budget. It has higher tax and non-tax revenues. Firstly, the government has got a 2.1 trillion rupee dividend from the Reserve Bank, whereas the interim budget had only estimated 80,000 crore rupees. So overall,
Welcome back. We're heading into a brand new day of trade. So let's get some technical experts on board to tell us how to approach the markets today. Mitesh Thakkar and Sudarshan Sukhani are joining in. Gentlemen, morning to both of you. Mitesh, let me start with you. In terms of the index itself, what is the expectation now? Do you think that we could be headed for some more pressure? And if yes, would you buy the dip?
See, I think the Bank Nifty between the two indices looks slightly weak to me. And could head towards 51,450, 51,350, and in the worst case scenario, even 51,000. So I think buying into the dip will be slightly an early kind of a movement. I would still want to hold my horses. I think maybe around 51,000 if we can get some reversal signals on the hourly charts, maybe then. So my view is slightly negative on the banking side, and that's why I'll avoid buying. Because the Nifty also has 40% weightage from the Bank Nifty. So for the timing, I think just wait it out. The Nifty might not fall as much. It might be more of, consolidating sideways, giving more of, doing more of base building. But the Bank Nifty looks weak and therefore avoid buying the indices.
Okay, all right, got that, Mitesh. Let's get in Sudarshan as well into the conversation. Morning, Sudarshan. What's your view on the indices?
Yeah, good morning. See, the Nifty made a low yesterday, and I'm assuming at least for a short period of time, that low will hold. But there is no momentum on the upside, so the chances are that we will go through a process of consolidation. Inside this consolidation, because we are still in an uptrend, a dip is a buying opportunity. So if you see a 100-point decline from the opening price or from the day's highs, that's where you go long, keep a 100-point stop then. I would not advise any short positions at this point of time, so the trend is clearly up.
Okay, all right, got that. What about individual stocks, Sudarshan? You give us your list first, then we'll go to Mitesh.
Sure. L&T Tech is a buy with a stop under 5,000. Ambuja Cement is a buying opportunity. It had a good day yesterday. It's in a trading range, just breaking out. Stop under 660. You have to adjust the stops depending on how the market opens. I have two intraday short sells. One is Godrej Properties, which is an intraday short with a stop above 3,200. And finally, Muthoot Finance, another intraday short, with a stop above 1,800. It's going to be a choppy market.
And Mitesh, what about you? What would your stock ideas be for the day?
I have a mix of buys and sells. On the buying side is Bata with a stop at 1,544 for targets of 1,600. And Escorts gave a good reversal after about a week and a half of correction. So that could see levels of 4,300 and buy here with a stop below 4,050. Metals look weak to me as a pack, and therefore Hindalco is a sell. Keep a stop at 668, look for targets of 620, and a sell on IRCTC with a stop at 990 for targets of 940.
Okay, thanks a lot for that. So those are some stock ideas from our technical experts. But HUL reported an in-line performance for Q1 with the volume growth meeting the street estimates and gross margins improving by 150 basis points. Ritesh Tiwari, the CFO of HUL, in a post-earnings media conference said that they expect growth to fully recover as rural comes back in the upcoming 2 quarters. Listen in.
More than 50% of our business today is already having high single-digit volume growth. And of course, there are parts of the business which will further respond, but overall recovery has been good. Urban markets we had called out had already recovered in terms of its momentum and volume in terms of total FMCG. Rural, which is still lagging to some extent, but in last couple of months, rural market growth has started outpacing urban market growth. So I believe where we are in terms of market recovery, sans the pace of growth, which we should see next couple of quarters as rural fully recovers with full-on impact of the monsoon, which is pretty decent as we speak today, and the interventions which government has given on rural, on agriculture, on employment, on urban, all that should help us to further augur well for the economy and also for consumption climate overall in the country.
Okay, that's the word coming in from HUL. Abneesh Roy joins in. He's the Executive Director at Nuvama Institutional Equities. Abneesh, hi, good morning. So the numbers were largely in line, but it was also muted, right? I mean, volume growth barely 4-5%. Do you think HUL can do better in the quarters to come? And what's the view on the stock?
Yes, we are positive, and stock has moved up 25% in the last 4 months. It's at a 52-week high. So some profit booking in the near term is possible, nothing major. But we have a target price of 3375, and we do see further market share gains. Currently, if you see, HUL is gaining market share in 55% of the portfolio. In the good times when the adverse cycle of inflation deflation was not there, they used to gain in 75% of the market. They have done a very good disruption in soaps. They have reduced palm oil by 25%, and they'll give back the benefit to the customer. That should help market share gains in soap. In parts of the portfolio like hair color, they are in double-digit volume growth. In the fabric wash, they are high single digits. So in Q1, the muted numbers which you highlighted, I will say that was only because of the severe heat wave. That impacted tea, coffee, the Horlicks portfolio. That is no more there. Yesterday's budget clearly was pro-poor, and definitely we are going to see 2.66 lakh crores in terms of rural development, 1.5 lakh for the agri. So many state elections are also happening. So if you see what Maharashtra government has done, because elections are coming, what Karnataka has done, and other states like Jharkhand and Haryana also state elections are going to happen. So those are also positive. So I will say pricing will come back for Unilever, volume also further recovery will happen. And clearly there's a coalition government. So the investors have visibility of 5 years that this will be pro-poor budget, pro-poor policy. And urban also, if you see, there have been tax cuts. So we are positive on the sector, entire sector we are positive. HUL also some profit booking can happen, but 3375 is the target price.
Okay, got it. Hi, Abneesh, always good to hear your thoughts. Thanks a lot for joining in. So big rally is what we have already seen. But from a market perspective, from an index perspective, the street wants to focus more on ITC. No shocker coming in the budget. One of the underperformers in the last 12 months or so. Till just last week, the stock was still negative. And valuation, there is some comfort. But it's already jumped up by more than 20%, I think, in the last 45 days. What's your view on ITC from here on?
Yeah, absolutely. In ITC also, we see improvements in their parts of the agri portfolio, FMCG also, because of the rural recovery going ahead. In terms of cigarette, absolutely, you're right. There is no tax increase, and the next budget will be on February 1. So just 6 months reprieve is there. We'll get to know what happens on February 1st. But my sense is the government should not increase taxes even then. So we are positive on ITC. Definitely, we see new highs being made in the coming months. And hotel demerger also, it's in the final lap. So that also, the further approvals are likely to come. So we are positive on ITC, and the valuation comfort plus the 4% dividend yield is also there. So yes, the stock should do well. Near-term numbers will be a bit muted. We expect 2 to 3% volume growth in the cigarette business in Q1. But in the rest of the business, we see a recovery because of the rural.
Oh. Okay, and what about Titan? This customs duty on gold and silver has been reduced from 10% to 6%. What kind of impact do you think it would have on Titan in the near to medium term?
I think it's a very, very welcome initiative because smuggling had become very rampant. So a lot of the local jewelers who were able to compete because of the smuggled gold, those will clearly see much tougher to get the smuggling, because now the difference is much limited versus legal and the smuggled gold, because now from 15% the duty is down to 6%. So clearly 9% kind of a cut on the gold pricing is happening, and that's going to propel a lot of volumes before the festival season. So yes, good benefit for all jewelers, including Titan. But in near term, what will happen, whatever the jewelers have paid with higher custom duty till yesterday, that small time inventory loss can happen. Whenever the results come, we'll get more clarity. But that's just a one-off. So yes, clearly volumes will go up before the festival season. So this will also help them become more competitive versus the local jewelers. So that's a positive for the sector and for Titan also.
Abneesh, just one last point. I was sort of discussing this with Naren earlier, that rural sort of allocation is down once again in 25 over 24. And it is, that budgeted number. And this has been true for the last 4 or 5 years. So, that broad flip which many were expecting, I mean, that's not really come through, has it?
So 2-3 things. Naren also highlighted that you have to look at the indirect bit also in terms of the infrastructure development. If Bihar and Andhra are going to see so much infrastructure development, obviously that's done by the rural poor in terms of jobs, plus the skill development and all this initiative of the jobs which the government is driving. Please also note what Maharashtra government has done, right? So many freebies. So don't look at the union budget only. You'll have to look at what Karnataka government came back to power by those 5 promises of 52,000 crore outlay to the rural and urban poor. So I will say that this is a mix of the union government and the state government. So that's clearly there. Now coming to specific numbers, if you see 2.66 lakh crore for the rural development, 1.5 lakh crore for agri, everything doesn't need to happen in budget. If you see MSP hikes also, which came around 1.5 months back, that was also much higher than the last 6-year average. So government is going in the right way. We have the 5-year visibility of a coalition government. And currently, if you see the elections, whatever data is coming, I will say that the government will be very focused on the rural and urban poor both.
All right, got that. Abneesh, good to speak with you. Thank you very much for your time. Appreciate you joining us here on CNBC TV 18. There's 4 minutes to go for the market opening. Let's bring in our 9-10 calls as well. We have Mitesh joining in and Sudarshan. Mitesh, what do you have?
I'll suggest a buy on escorts for targets of 4,300.
And Sudarshan?
Consider buying Ambuja Cement with a stop under 660.
Okay, well, ITC and Titan are definitely in focus, as we just spoke about them a while back as well. Mangalam is here to tell us the latest on that. Mangalam, over to you.
Well, a big mover yesterday, both ITC and Titan, the top Nifty gainers. No changes in tobacco taxation announced, and recovery in the non-tobacco business will be something that the street will eye as well. And there are a couple of brokerage notes coming in. So we have Jefferies, which has upgraded the stock, saying that it comes out as a clear winner. In fact, they don't expect any GST changes until May 2026 as well. They've upgraded their EPS estimates by 1 to 2% and raised their target price to just under 600 rupees as well. Macquarie too this morning has increased their EPS estimates by 2% for the next 3 years, and they expect better volume growth given no changes in taxes. They've upped their target price from 535 to 562. On Titan, the total tax on jewelry down from 18.5% to just about 9.2%. Street eyes better Q2 and beyond. Senco yesterday told us that there will be an increase of 9 to 10% in immediate sales on account of this. CLSA has maintained their outperform rating target just shy of 4,000 rupees, and Macquarie too has raised in their EPS estimates by about 1 to 2% to factor this customs duty cut. So after a big move yesterday, expect some more to come by today.
Okay, oil marketing companies also in focus. Sonal is here to tell us more about that. Sonal, over to you.
Well, good morning, Sonia. Nuvama has put out a note. We've been talking about budgetary allocations this time around, and the budget fine print suggests the expense allocation by the central government to the Ministry of Petroleum and Natural Gas does not include anything on the recoveries or the under-recoveries by LPG for these oil marketing companies. That's a negative. This is because BPCL in its con call did indicate that their under-recoveries will be widening going forward because the declared price for LPG sales is below the cost to OMCs. This time around itself, they had booked under recoveries of around 2,300 crore rupees for LPG itself. And we'll get to know about HPCL and IOCL after their numbers. With no budgetary support declared, OMCs are likely to continue to bear losses on sale of LPG, according to Nuvama. The second thing is, remember, the government had announced that they will be financing all these oil marketing companies. There will be some support in terms of funding to the tune of 30,000 crore rupees, but nothing fructified in FY24. The companies had announced rights issue as well, but there was no further update on that. And now this allocation has not been made in FY24 budget as well, and that is something that Nuvama is worried about. They say this indicates that the government's plan to infuse capital is off the table for OMCs, and that is something which could mean no financial support for them for transition to green energy and other capex plans as well.
All right, Sonal, thank you very much for that. On your screen, the pre-open rates and how they've settled. 30 points lower on the Nifty. The Sensex is down about 85 points. And, we're at 24,445 and the Sensex at about 80,343. So straight out of the bat, of course, we'll track indices, etc. But we'll also track earnings because they are going to come back into focus. And I think the problem for the market more than anything else is I think there is a pretty pronounced slowdown in earnings momentum that we're seeing in Q1. Let's just look at the numbers we've had so far and just try and find big beats. I mean, you'd struggle. And misses, there are many. So I think that again comes back into focus more than anything else in terms of individual names, etc. So just that's the well, and we're off to the races. 24,445 is where we are. 36 odd points lower, 30 points lower. 24,450 is where we're at. So it's marginally down. Bank Nifty is starting about 190 points lower. 51,556. Sensex is down 200 down. Mid-cap index is down, actually not down. Mid-cap index is absolutely flat, so it's doing better than what large caps are doing. And I think you'll also just look at the small cap space and what that is doing as well. So mid cap index is in the green, small cap index is in the green, and market breadth is positive, 2:1, favoring advances to decline. So that's essentially where you're at. I mean, the ITC boost continues for the market. ITC is up 2% once again after yesterday's near 5% rally. It was the single biggest index point contributor to the Nifty, and there is more coming this morning. Sonia.
So, you know, it's not a bad opening at all. Given the kind of announcements we had in the budget with regards to taxes, I would have assumed at least day 2 would have started with some gash, but no. Flat to a bit of a negative bias. The mid-cap index is actually in the green by about 200 odd points. Bajaj Finance is your top loser on the back of the numbers, so that one is down about 2 odd percent, but I think that was expected. So it's, you know, now gaining traction in terms of volumes as well. HUL is also down about 1%. Britannia is down 1%. Tata Consumer is under pressure. So these are stocks that are trending in the red right now. Couple of these pharma names also not looking too good. Cipla is down almost 0.7%. What's doing well is ITC. It's a fresh 52-week high on ITC. Titan is up almost about 0.8% on the back of the 6% gain yesterday. HDFC Life, Tech Mahindra, Coal India, ONGC are a couple of other stocks that are trending in the green right now. Lots of stocks in the broader markets as well, but what really stands out for me right now are a couple of these PSU names. So something like an IRDA is up almost 2.5%, some buying interest seen there. RCF, IRCON, IRFC, IOC, NBCC, you know, all in the green right now. BEL as well. So defense has come back a tad bit. But otherwise, for the market, it's very quiet. What really stands out is ITC at a fresh 52-week high. The headline index very, very flat with a bit of a negative bias. And since we're talking about 52-week highs, United Spirits also, by the way, is at a fresh 52-week high, post its numbers.
Well, that's right, Sonia. A few more stocks to put down the list. You have ICICI Prudential. That one's doing very, very well. Yash had told us those numbers were quite good. The stock opens up with a gain of around 4.5%. So good move up there. Bagel Projects, they are backed an order worth around 580 crores from Power Grid Corporation. That's coming up as one of the top volume movers in today's trading session. So Bagel Project should come up for you on the screen. You have Thyrocare. Well, that one, in fact, is flying away. The volumes are yet to pick up substantially, but for the time being, the stock has opened up with a gain of around 5%. The margins have expanded yet again to around 27%. That compares with around 25%. Explains why the stock is up and about. And Borosil Renewables, a 10% basic customs duty on imports of solar glass has been taken very, very positively. And that's why after yesterday's big gains, you have Borosil Renewables, that's up yet again with a gain of close to around 6% or thereabouts. Parag Milk as well, the first tick was in the green, so good going out there. Let's check out if there are any negative earnings reactions. Mahindra & Mahindra Financial, Abhishek had told us elections, heat waves, floods, well, they all impacted the disbursements. For the time being, that stock is more or less flattish. And Vedanta, in the next couple of days, we'll be waiting for the dividend announcement. For the time being, I think the stock had opened up more or less flattish as we speak.
Okay, well, you know, that's essentially where we are at. Just, you know, I don't know, Muthoot and Manappuram, if we can have those stocks up. They both were down 5 or 6% yesterday. I mean, is the damage done and is the market adjusted? Manappuram is flat. Muthoot will come up on your screen as well. That's down about 1/3%. Some other specific budget stocks, Borosil Renewables was a big mover yesterday. So maybe we'll have that up. Was up about 9% in trade. That sort of import duty exemption has finally been done away with. So there is support for the business in terms of regulation. Another 7% this morning. So 35-36 rupees on Borosil Renewables. Let's just look at real estate stocks as well. Because I think yesterday they did come under some pressure. But take a look at, you know, start with DLF and Oberoi is starting 1.25% higher. Look at Macrotech, DLF. DLF is down 1%. Macrotech is up 1%. So it's mixed. So let's look at Sobha, Prestige, Brigade, etc. The Bangalore-based players as well, and see if there is anything coming through in that segment as well. So Sobha is up 2.5%. That's a 40 rupee gain. Prestige is up 1%. Brigade, etc. will come up. So, you know, so it's an interesting space, of course, and a lot of debate. You heard from Naren as well in terms of, you know, what this does to the taxation bit does to sort of prioritize or make certain sectors more attractive, certain asset classes more attractive, and of course makes others like debt mutual funds especially less attractive. Index is flat as they come. And this is essentially what we were saying in the morning. VIX was down 18% yesterday. So nothing very big to be expected, at least in the near term, or day two and beyond. So that's where we are at. More stocks we'll put up on the air in just a bit from now with specific moves. But let's bring in Shiv Puri, who's with us as well, founder and managing director at TVF Capital Advisors. Shiv, good morning. Great to have you with us here. Thank you for your time. The tax bit just sort of watered off the duck's back, Shiv. Nothing at all. And we've moved on, looks like. Yeah.
Sorry, I was just going to say, I think the budget as a whole was a very conservative kind of budget, more of the same, what we saw in the interim. I would have hoped for a slightly bolder budget in terms of spending. We have an economy that is very strong, and fiscal consolidation is, of course, important. But I wonder why we are focusing on it, so much when growth is pretty strong. Fiscal deficit projections in India are 4.9% of GDP. In the US, it's 6.5% of GDP for this current year. And India is growing at 7-8% real. The US is growing at 2 or 3% real. So I wonder if more spending could have happened to boost consumption, especially in certain pockets of the economy for the current year, given the backdrop that we have.
You're saying, sorry, you said you're wondering why we are so focused on the fiscal deficit, is what you said, Shiv? You're going to probably spend a little bit more?
Yeah, I think so. I think there's a lot of conservative assumptions that are being made in keeping that fiscal deficit under 5% of GDP.
Got it. And are there any market sort of implications of not spending more? I mean, I was sort of discussing earlier that rural spending actually is down for 5 straight years now. I mean, the allocation. There are different ways in which the money gets to what we call rural, but in terms of the printed number, the allocation is down. Yeah.
Yeah, absolutely. I think you'll see it in corporate earnings for the next couple of quarters. I think earnings are slowing down a bit. And you're starting to see that not only in the rural part of the economy, but you'll start seeing that, I think, slowly a little bit in urban consumption as well. So I think there could have been a boost that could have been made for consumption. And maybe it'll happen over the course of the year. Maybe it'll happen outside of the budget. I don't know. But I was surprised to see the focus on keeping that fiscal deficit number at 4.9% rather than letting that move up a little bit to boost consumption across the economy.
Okay. Shiv, hi, good morning, and thanks for joining in. I wanted to also understand your view on the real estate taxation from yesterday, right? In effect, the announcements yesterday are a positive for real estate because the LTCG applicable rate has been reduced to 12.5% from 20%, although indexation benefits are not provided. But do you think that in the longer term, between real estate and the equity markets, what is your preference now, given what we saw in the budget yesterday?
From what I understand, I think these are two very different asset classes and very different set of investors. So I don't think movements in taxes to the extent that they've been announced will necessarily result in movement of significant capital from one asset class to another. The profile of investors in these two asset classes is actually quite different.
All right. Hi, Shiv. Good morning. Tell us the themes you like then. When you joined last time around, we discussed some good quality hospital companies, some discretionary companies as well. What are the top themes you're betting on from here on?
Well, I wouldn't have thought that prior to the budget, one would say tobacco and gold would be the two areas that came out ahead. I'm not sure that is the right kind of takeaway, but that is sort of the two areas that have benefited. I don't think those are interesting areas long-term for a whole host of other reasons. But I think the structural areas in India still look good. We've talked about it in healthcare and hospitals, even financial services, as always. You're seeing it, in industrials, but certain pockets, and one has to be very careful out there as to what's cyclical and what's structural. I think those are the three kind of main areas that I look at. Consumption is interesting, but I think consumption is slowing and it's continuing to be slow. And I think even now there are certain pockets in the equity markets that are not accurately reflecting the slowdown in the real economy.
Shiv, since we're indulging, Cigarettes as well as gold has got a bit of a booster shot. What about the alcohol beverage companies? United Spirits is up close to around 5%. Good, bad budget, good or bad days. People, they'll knock in a few, right? Either on the weekend or the weekdays. How do you view the space? And India is still an under-penetrated market.
I think one of the biggest dichotomies is looking at a top-down story without understanding maybe the bottom-up positioning. Alco Bev from a top-down perspective looks amazing in a country like India. You have huge under-penetration, consolidation, and a culture that is increasingly still moving in terms of consuming alcohol for the first time. But I think on a bottom-up basis, from a regulatory standpoint, from the intensity of how business happens in that space in India, it's actually a very difficult space. And whether the companies do actually be allowed to keep the profits that they make over the long term, or a lot of that's actually given away in taxes and duties is another matter altogether.
Shiv, you've been sort of big believers in banks and financials. That the top holding for you still?
Yeah, I think so. I think they still are structurally well positioned. Clearly, as the corporate capex cycle picks up, there will now be increasingly more demand coming from that side. I think retail is going to likely slow down for some period of time. There has been probably a little bit of exuberance in the unsecured personal loan, small ticket size category. And we will see, I think, in the next coming quarters, the asset quality get reflected over there, which will sort of, bring some caution to some of the lenders. But I think the corporate cycle will remain strong, and I think the long-term outlook is still that it's very underpenetrated.
Just a quick bit on taxation, since and does it change anything for foreign investors, Shiv?
I think it just makes it relatively less attractive as a market. And I'm not sure what purpose it serves. I'm sure they must have thought through why they wanted to do this. But I think from a relative basis, if you look at public markets, the long-term returns, are pretty evident in the sort of the 10 to 12% bucket for the Indian equity markets. And so when you start adding layers of taxes on top of that, relative to what other markets offer, it becomes less competitive. I was surprised to see the normalization between private and public, which seems to have happened in terms of the tax rate, because one would think, on private assets, your returns are higher given the liquidity risk. But now there's a normalization on taxes. Public markets don't offer that kind of upside, on a relative basis.
So in terms of sectors, in terms of, spaces that you would be optimistic on, Shiv, what are you looking at over the near to medium term? How does one approach the equity markets now?
I would think, generally a bit cautiously, right? The overall economy is doing fine, but you are starting to see, large pockets of the economy slow down a little bit. And we do know where valuations are, and I think they're pretty high. Generally across the board, I think it's still okay in the larger names, but at the smaller mid-cap names, it's head scratching to see some of the dichotomy in fundamentals and valuations. And we've seen these cycles before. I mean, over the last 20 years, it's happened 3 or 4 times. So I don't think the outcome is going to be any different. India has a few structural trends, which we've talked about, which is financials, healthcare, industrial consumables, consumer, etc. And I think one has to just be patient to ride it out in those areas.
One space that's caught everyone's attention in the last year or so has been the PSU basket. Some of them have run ahead of themselves. Some of them have run way ahead of themselves. But there still could be pockets which have valuation comfort, maybe like some banking names, the bigger ones. How do you approach this basket? Because that's where the big wealth has been created. But has it run its course?
One has to really believe that there is something very fundamentally different in PSU banks for valuations and to move up from here. Because if you look at the historical cycle over the last 2 decades, these banks tend to trade at, somewhere from half times book to 1.3, 1.4 times book. I mean, that's sort of been the range. It's clearly at the high end of that range right now. And so is there something fundamentally that's happened for these banks to change? Now, one would say that they're definitely better run than they were 5-7 years ago. And I mean, certainly from the trough of 2013-14, where asset quality issues across the PSU banks were so prevalent, I think all those days are behind. And the other area that I feel they've done pretty well is catch up on technology. They've also done, some of them have done a better job in gathering low-cost deposits. So, they have some strengths that are built. I'm just not sure that there's anything that's re-architected their business to make it significantly more profitable going forward, and valuations are at the high end of where they've been historically.
Okay. Globally, things have looked very good up until now, but there are some geopolitical risks. There is, of course, this big election that's happening now. We've seen Joe Biden step out of the presidential race. Putting all of that together, do you see any global risk for the Indian market now?
I don't think that there is. There's always geopolitical risk. We've lived with geopolitical risk for the last many decades. One could argue that the peak of geopolitical risk last year has been crossed, but of course we don't know what could come down the pipeline. From a global standpoint, if inflation in the West is under control, and that's a big question mark now if the Trump administration comes in. But if that does happen and you see interest rates softening, that is actually positive for emerging markets. I just think that the way both candidates have sort of announced their plans, and certainly under the Trump administration, spending is going to go up dramatically, and that doesn't usually bode well for their inflationary outlook.
Okay. Thanks a lot, Shiv, for joining in. Appreciate your time here on CNBC TV 18. That's TVF Capital with their views on the market. By the way, the mid-cap index is actually doing very well. It's up about 400 points. It is a relief to see that, given what we saw yesterday, the initial fall and then the rise. Kalyan Jewellers is really the big stock on your radar. 12% higher now on Kalyan Jewellers. You have a couple of others that are looking pretty good as well. Suzlon is one stock that is up almost about 5%. So let's talk about that. The company reported a very strong performance in Q1. Their order book was strong, highest deliveries in Q1, while the wind turbine generator margins also saw a stellar jump. To discuss more on this, we have Himanshu Modi, the CFO of the Suzlon Group, who's joining us now to talk about that. Himanshu, good morning and thanks a lot for joining in. It was a very strong order book that you saw. The revenue growth was quite healthy, almost a 50% jump is what you saw year on year. So I just want to start by asking you about, since the budget was the big event behind us, anything from the budget for your sector, anything that could boost demand and investments?
So clearly, I think, even beyond the budget, the sector has seen a lot of policy push from the government. Renewable energy as a sector is clearly on the radar. We're working towards a target that has been set by the regulators of increasing green energy inputs. So whilst there may not have been anything specific per se in the budget this time, but clearly, I think from a larger policy push perspective from the government, renewable energy sector is one of the priority sectors. That is very evident.
Okay, so that's on the budget. Can you tell us a little more about your own business? It was a very strong Q1. And can you give us a sense of the WTG deliveries that you had? How did it pan out? Any deliveries from the last quarter that spilled over into Q1? And what is the way forward in terms of Q2 and Q3?
So we did about 274 megawatts in Q1 in terms of delivery. Of course, this is for the quarter. So there's always be a spillover from one to the other, but that's just the phenomena. So 274 is what we did in this quarter from April to June. And our order book currently stands at about 3.8 gigawatts, which we need to deliver over the next, I would say, 18 to 24 months. So I think the outlook, it's fairly positive. And now the execution will start to play out. FY24 for us largely was consolidation of our balance sheet and, getting the working capital in order for execution of the order book. FY25 for us would largely be focused on P&L and the deliveries that we need to make out of our order book.
Okay, all right. Hi, Mr. Modi. Good morning and good to see you again. And, the stock saw a bit of a re-rating, but I think post these numbers, the street has got a little bit more confident as well on your deliverables. So let's talk about first the industry on the whole. The government has been talking about 10 gigawatt of, wind capacity addition on a year-on-year basis. For this year, though, how much do you expect the industry to add? That's FY25 as well as FY26?
So we, as an industry, added about 3.3 gigawatts in FY24. Our sense internally is that the industry would do around 4.5 to 5 gigawatts in FY25. Difficult to put a number for FY26 as yet, but I think certainly 4.5 to 5 gigawatts for the industry in FY25 should be doable.
And you would have close to around 30% of the market share. So if I extrapolate that, you'll be at around that 1.3 to 1.5 watt. Gettable number, right?
Yeah, so that's, of course, our historical market share has been around that ballpark. What FY25 holds, of course, time will tell.
Yeah, that's why I try to get it out the other way. So we are extrapolating that number and let's see how things progress. What about the O&M side of the business? How much does it contribute as of now? And margins over there are relatively better. How do you see that scaling up and the impact on the consolidated margins?
So margins there continue to be strong, about in the early 40s, so anywhere between 42 to 43, 40 to 43% is where we are seeing operating margins on the O&M business. That's, of course, a steady state business for us. Currently annualized revenues are close to about 2,000 crores, which historically in the overall pie have been close to about 25 to 30% of the overall pie. But as the WTG business keeps growing year on year, whilst the absolute number on the O&M will also increase steadily, but the overall share in the consolidated would decrease. And that would have an impact on the consolidated margins because O&M margins are certainly higher than that of the WTG business.
So what does it mean on margins from year on? You've gone up to around 18% as I see of the past quarter. Given the change in the mix, though you'll have some kind of operating leverage as well that could play out, what should be the number we should work with on an average for the year?
So, as I said, on the operating margins for O&M, about 40 to 43% is something that definitely is achievable. And
on the consolidated front?
No, I'm talking about the O&M.
Yes.
On the consolidated front, similar ballparks definitely is doable.
17, 18%, you can hold on to it, right?
Yeah.
Okay, all right. Also, if you could tell us, give us some color on the order book composition. As you said, it's looking very, very good. Break it up for us and tell us whether the better margin business will start now getting executed, which in turn, though your mix is changing on the O&M side of it, but, if the number of contracts you're executing is a better margin, that's what could support the profitability going ahead.
No, I think WTG margin contracts are pretty much, I would say similar pricing. There's nothing same pricing, but similar pricing and similar margins. Of course, operating synergies and efficiencies, economies of scale will start playing out over the next few quarters as and when we execute. But from a sales perspective, I think, our contracts are similar in pricing. Whatever operating efficiencies by cost management we can achieve, that is what will result into healthy bottom line.
Okay, well, Himanshu, we'll leave it there. Thank you very much for your time. Stocks up 5% and market likes, but of course, what you've done. Appreciate it. We'll take a quick commercial break here. On the other side, we'll be connecting with Atul Lal, Managing Director at Dixon Technologies, and we'll discuss what Dixon and the EMS sector made of the government's proposals for FY25. Stay tuned. welcome back. We have the management of Dixon Technologies now joining us. The Finance Minister yesterday announced that basic customs duty on mobile phones and chargers will be slashed to 15% from 20% earlier. Let's sort of talk about this. Atul Lal is MD at Dixon Technologies, the largest EMS player, which of course is now diversifying into so many newer areas, newer sectors. Mr. Lal, great to have you with us here. It's always a pleasure speaking with you. Prashant this side. Implications, sir, of this duty cut, if any at all?
Not at all. Please appreciate that the mobile manufacturing ecosystem in India has really matured. And we are of a firm conviction that mobiles being sold in India, practically everything will be manufactured in India. The CBU imports of mobiles is practically just 3 to 4% of the overall sale of mobiles in India. So this is just a duty rationalization. It has absolutely no impact on the manufacturing arbitrage, manufacturing competence, manufacturing story of mobiles in India. In fact, taking a couple of minutes more, my humble request is that the stakeholders should get into the fine print details that how the government has really interfaced with the industry and accepted a request for rationalization of various other duty structures, whether it's an extension of concession notification,
right,
whether rationalization of duty concession of the critical materials for semiconductors, on connectors, expanding the scope of connectors, on extension of concession notification beyond die and mechanics, on aluminum parts. So those are positive things. And the first step, a significant step of mobile manufacturing in India, which has already achieved a maturity stage, now the next stage is to deepen the manufacturing and create the component ecosystem. And the government very prudently has fine-tuned and rationalized those duty structures.
Got it.
Which we welcome.
No, and I'm sure they're hearing you. And point taken, Mr. Lal. Now, for allocation for PLI schemes, if you look at the sort of large-scale electronics manufacturing, that's up 36% as compared to FY24 budget estimates. But if you look at allocation for IT hardware, that is about 50% lower as compared to FY24 budget estimates. Your thoughts?
So we are hopeful and we are in a positive frame of mind. We feel that as electronic manufacturing is concerned, the government has been positive in response and will be rolling out a package for the component sector, and this time for the non-semiconductor component domain, which is again what I mentioned earlier, is in line with deepening of manufacturing and enhancement of value addition. As far as the IT PLI 2 is concerned, the scheme is just in a takeoff mode. I think it's going to take some time for it to achieve a certain level of gravitas. So looking at that, I think the allocation has been revised a bit lower. But I think it's just a matter of time. Every scheme, it takes a couple of years or slightly more till the time large global brands start doing manufacturing in India, and then it acquires a certain mass. So I think it's in that direction. In the overall scheme of things, I don't see any negative element, even in the IT PLI 2.
Okay, all right. Hi, good morning, Mr. Lala, and thanks a lot for joining in. Well, and their stock price is telling you that, right? The street wants to give you a few years. They believe there's tremendous potential as well. My basic question to you was on the mobile industry. We have talking about value addition, the PLI schemes, a lot of focus out there. Tell us, what is the cost of manufacturing that mobile phone here in India? And you compare it with China. And has that gap narrowed in the last few years? And how do you see this panning out? A very basic question.
You see, there was a disability. And for covering up the disability, any government should be doing the handholding of the industry in its stages of infancy. And that's what the government has done. And the first PLI mobile scheme, wherein it started with 6%, presently in the current fiscal is at 5%, next year is going to be 4%. I think is fairly good to compensate at level 1. But now there is another angle to it, that when we started mobile manufacturing in India, there was hardly any component ecosystem. And until unless we have the depth of supply chain, anything that we are doing at the assembly stage, at the device manufacturing stage, is not beyond a point sustainable. So that's the reason we are requesting that the government should cover up for the disability in the component ecosystem, because our neighboring countries are much ahead. They're 2 decades ahead of us in that particular category. So I think there is a disability there, and that's where we need the package. And also the financial metrics of the component ecosystem for mobiles or even the other electronic parts are very different from device manufacturing. The asset to turnover ratios in device manufacturing can be 1:10. In various components, is barely 1:1. So it requires a different kind of treatment. It requires a different kind of handholding. And let me assure you that once that happens, and the value addition, which currently is somewhere in the range of around 17-18%, goes up to 30%, then it's a huge industry. And not only for servicing the domestic requirement, it's for servicing the global requirements. And I think the industry is moving in that direction.
But you wouldn't be able to put a number to that? The difference, what that was, that is, and that will be?
As far as the mobile device manufacturing is concerned, I think we are almost there. But when we look at the various components, I think the disability would be in the range of around 7 to 9%.
Okay, all right. A good conversation, Mr. Lal. Cost of manufacturing in China has gone up. So I think that has helped as well in that sense. And cost here has probably gone down. And, of course, the hand-holding that you spoke about. Mr. Lal, thank you very much for joining us. Good speaking with you here as always, and good luck till our next interaction. Now, real estate investments have lost the benefit of indexation, which allowed property owners to adjust their gains for inflation. Finance Secretary clarified to CNBC TV 18 that the tax incidence under capital gains without indexation is lower, will actually benefit a lot of people. So, I mean, a lot of debate and argument around this one, but you just want to play out that soundbite from the Finance Secretary.
What we have tried to do is that inflation in India is fairly predictable in the long run. We have checked that the average rate of growth of the cost inflation index, which is used for capital gains, is about 4.6%. So it's predictable. We know that on average your assets, for tax purposes, see, individual assets may go at different rates, but we use a steady index for tax calculations, which grows at 4.6%. Now, let me give you a numerical example. I don't think anyone would make the case that property will appreciate less than a fixed deposit. That's not why people buy property. They buy property because it appreciates faster. And India is a land-scarce country. Property is bound to appreciate faster than most other assets. So let's say you expect property to appreciate at, let's say, 15% per annum. Take off 4% for inflation. Currently, with a 15% gain, you're taxed on 11%. Because every year you get a 4% knockoff for indexation. On 11% of the growth, you're paying 20% of that. So 2.2 is the tax that you pay. In the new system, you will pay 12.5% of 15%, which comes to 1.87. So it's lower. It's lower at almost any reasonable rate of growth for real estate, and we have calculated this. We have calibrated to be, in fact, for us it will be negative, because in most cases, the tax which would be computed on an indexation basis would have been higher than the tax on the non-indexed but much lower rate that we have imposed. So we've tried to keep it at a level where almost nobody will lose. A lot of people will gain because the indexation benefit will be less than the benefit that they would get. And one more thing I want to add. We will continue to start valuing property only from 2001. So it's not as if that benefit is taken away.
That benefit is not taken away.
That is not taken away. The value of the property will be the value as of 2001 or of the date that it was acquired.
Okay, clearing the air on this entire, confusion around real estate taxation. But in effect, I think the announcement yesterday is a positive that came through. The fact that long-term capital gains applicable on real estate has been reduced to 12.5% from 20% earlier. Let's discuss more on this development. Ghulam Zia, the Senior Executive Director at Knight Frank India, is with us. We also have Gautam Lokhande, who's the partner at KPMG India. Gentlemen, morning to both of you. Ghulam, first I want to understand from your end, right? For someone who perhaps owns a property, both a legacy property and is looking to buy a fresh one, what are the implications of the announcements that came yesterday?
Good morning to you all. First of all, I was just looking at the arguments that the Secretary is putting up, and it is all completely revolving around expected gain per annum of about 11% after inflation adjustment. which is actually not possible. Last 3 years, we have seen the property cycle growing up. The annual growth of property prices are still in the range of 7 to 8%, not considering inflation. So there it is. The whole argument that at least he's putting up is something which is, to me, is applicable only if property prices are appreciating 10% plus per annum, which we haven't seen in last so many years. In fact, if you leave aside last 3 years, prior to that, we have seen a free fall in property prices for almost about 9 to 10 years. And that inflation adjusted would be negative. And that is where, while the whole argument that one is putting up has to be seen over a period of time, multiple factors go into it. But then at least looking at this argument that the property price have to go up 10% per annum is not something which cuts eyes. At least I haven't seen that happening. So net, most of us believe that in the long run, the gain that you will get out of this new policy will be neutral to what it was earlier. But then we'll have to see case-to-case basis, different arguments. But I think I'm not fully convinced that there is no loss due to change of this regime.
Okay, got that. Ghulam, that's very well put actually. So you're saying that the lower tax implication that you will have is only in case of a higher price appreciation of more than 10% on an average. And that is something we haven't seen, but that is mostly the case with metros, right? Across the rest of India, we have seen many areas, tier 2, tier 3 cities where there is more than 10% price appreciation. So in effect, do you think that broadening of the real estate sector is something that could take place? Where people, rather than looking at metros because there is no price appreciation, move on to the broader part of the sector?
That's also not true, because price appreciation also is not every year on year 10%. You can't imagine that every 4-5 years you will see 10% price rise. First of all, real estate is cyclical, which is all of us are aware of. And then at least your argument right now is that in non-metro cities, price rise is much higher than the metros. Once again, something which I don't fully subscribe to. So you'll have to once again look at it from case to case basis. At least I'm not convinced that the property price growth has to be inflation adjusted in double digits. That, to me at least, is not possible.
Okay. Ghulam and Gautam, thank you very much for joining us. Prashant here. Gautam, if I can come to you, what does this mean for new real estate sales? The removal of indexation benefits, Gautam. And from a builder perspective, is it not positive? Because you're basically paying 12.5 as opposed to 20 earlier.
I agree. So I would look at this in two different segments. The impact that a retail property seller would have, and then the corporate side. For retail taxpayers, Ghulam has outlined the picture well. I would broadly agree with it. And again, it has to be a case-to-case assessment depending on the nature of the asset, the cycle in which you sort of purchase the asset. And again, if you've managed to beat inflation significantly in terms of the compounded rate, I would believe that you'll be better off. And if not, I think you're definitely not going to be seeing a good benefit because of the tax change. On the corporate side, Prashant, what you mentioned is right, in the sense that a lot of developers are looking at this very positively. If you look at the corporate transaction market today, a lot of exits being planned by promoters to funds and private equity players, particularly in the commercial real estate side. Promoters will be very happy with the reduced tax rate of a 12.5% vis-a-vis a 20% that was there applicable earlier. So that is very positive, and in particular, a lot of players who have been looking at the REIT market, investors in REITs, also get to benefit because of the change, because their period of holding drops from 36 months to 12 months, and they get to enjoy a lower rate of tax if they have held on to the asset for a shorter period of time. Yeah, I think these are the two, I would say, impact areas from a corporate side. Over to you.
Okay, all right. Thanks for that, Gautam. Well, let's go back to Ghulam. Ghulam, I wanted to understand, we're talking about this resurgence of the real estate cycle in the last, say, 3 to 4 years. Do you have some rough numbers? How much of these purchases that were done in the last few years, say last 4-5 years, were for end use, and how much of that was for investment, if you'll have a rough number?
It's very difficult, but then if you have to just look at back of the envelope kind of trends that are happening, 3 years back, it was more or less all for end use. But after that, as the prices started going up, 5 to 10% kind of a growth. In a few very rare projects, we have seen prices going up above 10, 11% as well in last year or so. In such projects, you would see investors also coming in hordes because they now want to believe that the cycles have turned and the prices will continue to grow in next couple of years. So while that argument is not completely wrong, but then also that it's a very small number of investors who are jumping in. In my view, it is still not more than 15 to 20% of investors vis-a-vis 80 to 85% of end users who are still buying. And that too in very small pockets. You know, when you're talking about some, a few of those top developers selling huge number of assets, huge number of properties in say Gurgaon or South Mumbai, that is where your number of investors may be slightly higher. But on a broader perspective, I don't want to believe that the number of investors would go beyond 15% out of whatever sales happening in last year and a half.
You mentioned Gurgaon, Ghulam. What would the number for Gurgaon be? I mean, in terms of investors?
That could perhaps go 25-30% as well, because this is something which is happening just recently. Last year, we have seen some record-breaking transactions where people are actually standing in the queue and buying. This reminds us back of about 15-20 years back of a cycle upside. But again, as I said, it won't be more than 25 to 30% of investors' share in this market.
Okay, earlier you said that the annual returns on property prices on an average have been only 7 to 8%, right? I mean, is this across the board? And what is the time period you're looking at?
Well, as I said, if I would set aside last 3 years, prior to that, we had a bad cycle. In fact, all the way till COVID and even 21. 2021 is when the property cycle started turning around. Prior to that, we had at least 8 to 9 years of a free fall. And inflation adjusted, those days we used to have negative returns on property price appreciation. It's only last 3 years we've started looking at about 7 to 8% average growth across the country, across the markets, urban, rural, tier 2, tier 3. It is still in the range of 7 to 8%. And then you have to also adjust it for the inflation.
Okay. The other thing, according to me, was a very important takeaway from the budget is that the government is now encouraging states to lower stamp duty on property purchases for all. They've also considered offering a lower stamp duty for properties purchased by women particularly. Now, Ghulam, we've talked about this, I think, for the last 10 years, right? The fact that higher stamp duty rates is one of the key reasons for home prices going up so much. So your thoughts on are we looking at this lower stamp duty becoming a reality? If yes, is this a big positive?
Well, at least when the cycles are going up, stamp duty 1% or 2% here and there really doesn't make much of a difference. I'll make a case here. About immediately after COVID, Maharashtra was the first state to offer stamp duty reduction. And that stamp duty reduction lasted for not more than 7 to 8 months. After that, they have actually taken the stamp duty up. In fact, recently, last year and a half or so, they have added a 1% metro cess. So net, we are paying 6% stamp duty in Maharashtra. And in spite of that, the number of transactions is absolutely path-breaking, historically highs. So the point is that just because stamp duty 1 or 2% here and then tweaking would change the market, I don't completely subscribe to that thought. And that even that 1% reduction for ladies buying an apartment is something existing in Mumbai, in Maharashtra for last 2.5, 3 years. So none of these things are new. What the central government is talking about is broad-basing it to other states as well. And maybe other states where you haven't seen any impact of stamp duty reduction may behave slightly differently than what we have seen in Mumbai. But net, these are again, as I said, this is a state subject. Every state will have to be convinced. And one of those states which will be worried about loss of revenues on account of lesser stamp duties, center will have to think about how do they compensate for that.
All right, Ghulam, it's always great speaking with you. Thank you, Gautam. Good to speak with you as well. And we'll continue to discuss some of these aspects in the coming weeks as well. Thank you for joining us here on CNBC TV 18. I just want to quickly highlight the real estate stocks. Soba Developers is up 7%. We should have that up. 1896 on Soba. You look at Prestige, that is up 4%. Lodha is up a little less. It's up about 2% or so. So Soba, Prestige, there's Lodha Developers. And there is a Max Estates as well, which is up about 4% as well. There are a few, which are doing nothing, but nothing is down really. They're flat to down about 0.5%, 1%, and then there are these other stocks which are up 4 to 6 odd percent. So market, of course, sniffing some of this stuff out in terms of what's going on. Mitesh is with us to run us through what to do now in terms of trading ideas. Mitesh, what do you have?
Prashant, the buy on NTPC with the stop below levels of 382 for targets of 400. And Nestle, I think, has broken down. Some negative setup has happened over there. So sell here with a stop at about 25.70 for targets of 24.50.
Okay, all right. Thanks for that, Mitesh. Well, talking about real estate stocks, just one mention of DLF. That's one of the lone stocks that's down close to around 1.5% as we speak. And on the upside, adding to the list, there's Arvind Smart Spaces. That's up close to around 4.5%. And it's gone up in the last few minutes or thereabouts. Well, time to slip into a short break. On the other side, we'll connect with the management of TeamLease to understand the benefits of what was announced yesterday on job creation and skill.
I'm endorsing Vice President Kamala Harris because she's ready to step up, bring our party together, go toe-to-toe with Donald Trump, and win in November.
Kamala Harris is at the top of my list. I know her well from having worked with her in the Senate, on the Judiciary Committee, sitting next to her on the floor of the Senate, knowing her and her family personally.
I think Vice President Harris's energy, her enthusiasm, the time she spent here connecting with Pennsylvanians, she's no stranger to us. She spent a lot of time here, and I think people will be ready to enthusiastically support her.
Okay, welcome back. We are, of course, touching upon various specific companies, sectors impacted one way or the other because of the budget yesterday. And we have with us the management of TeamLease Services and what they make of the announcements in the budget on jobs and skill development for youth. Skilling was a big focus area on which the Finance Minister spent a fair bit. And I think there's a 30% increase in budgetary allocation towards education, skilling and employment, which has come through. We have Ramani Dati, CFO at TeamLease, joining us now to respond to what is announced. Ramani, great to have you with us here. For a company like TeamLease, what is the most significant announcement from the budget yesterday in terms of all of the schemes, etc., which were announced?
Sure. Now, firstly, for our industry, staffing industry, the biggest challenge is formalization. While there are many jobs that are getting created, only a handful are moving into formal sector. And the market share of organized players like us is less than 5% in the overall scheme of contract jobs. So the initiatives that were announced yesterday are mainly driving towards formalization of employment because all the schemes that they announced are towards driving more and more employment with EPFO, which is more of formal jobs, and encouraging the first-time job seekers. Because, again, one of the challenges for our industry when we compete with the informal sector is the difference between, Hath Wali salary and Chitti Wali salary, because of a significant amount of the CTC that is going into statutory contributions, be it PF or ESIC and other contributions. And with government coming up with more schemes which are supportive to first-time job seekers, additional employees, mainly in terms of their contributions towards EPFO and first month salary. So these will definitely boost more formalization in the contract staffing space that we operate in.
Okay, this is a hot topic right now, right? I mean, employment, job creation, etc., Ramani. So do you think there's anything more that the government could have done to facilitate further job creation, apart from what was announced in the budget?
No, this is a good start because the next major step that we would like to see in terms of job creation and more formalization is towards notification of the labor codes. Because that will be the biggest drive in terms of the shift from informal to formal jobs at a massive scale. And since these labor codes have already been approved by both houses of parliament, and it's only the notification that is pending, so we are waiting for the notification on the new labor codes implementation. So we believe that can be a big game changer. I mean, it won't be at a click of a button. It will be more like a gentle sunrise in terms of the transition towards formalization of jobs. But that would be the next major step to boost employment on the formal side.
Okay. Also on this Karnataka job reservation bill, right? I mean, there's so much debate. There's back and forth that's happened on this one. NASSCOM has given its comments as well. But what would your own thoughts be on what the impact would be on tech companies in Karnataka, in Bangalore? Do you think a lot of the, the restrictions could force companies to relocate? Because that seems to be the common narrative now.
Yeah, definitely there'll be an impact. And with a lot of debate going on, I think it's too early to jump to any conclusions and comment on this. So in terms of, since you specifically asked about IT companies, so many IT companies are all now talking about resorting back to work from home, if this is going to be applicable to the local presence of employees. So some of them are also considering rolling back to work from home option, and can that also give an exemption for them aligning to this requirement. So, I mean, this is very initial stage, lots of discussions are happening, but it will definitely have an impact.
Okay, all right. Thanks a lot, Ramani, for joining in and explaining that to us. Well, shifting focus to the commodity markets now, Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, Sonia, I'm looking at the gold prices, where we have seen the prices decline slightly in the international markets, and that is because of the dollar's strength, and that's weighing on for the Indian markets as well. For the Indian markets, it also is about prices declining below or off its all-time highs that we saw in the previous week itself. For the international markets also, it was at around $24.70 an ounce, which was an all-time high, and we have seen prices decline just about to $24.10 or 20 at this point in time. Well, it is the US Fed meeting on July 30th and 31st, so any guidance that comes out of that will be of most importance. And then apart from that, there's a very interesting Goldman Sachs report overnight which says that the gold prices are headed towards yet another all-time high of $2,700 an ounce, but that would be in 2025. But, well, absolutely, when it comes to the Indian markets, it was all about the budget and a very surprise strong duty cut that we saw come in for gold, silver and platinum and various varieties of that as well. So the gold prices slipped by nearly 5% yesterday after budget. And then it is about the basic custom duty cut, which we saw from 10% to 5%, and the agri cess was also cut to 1% from 5%. So the total duty that used to be at 15% earlier now stands at a 6%. So with this 9% slash coming in for the duty, you did see a price decline come in for the markets there. The GST for jewelry right now stands at 3%. So for jewelry, it comes at around 6 plus 3%, which is 9% is what people will have to pay right now. Well, when you look at the consumers, it clearly is positive, especially coming at a time when you are looking at festivals and wedding season starting right from next month itself. So, well, yes, the markets are anticipating huge buying coming in for the next week or so. But the other thing also is that when you look at the Indian markets and the buying patterns that we saw in the previous year itself, and this is as per World Gold Council, Indians bought jewelry worth 576 tons and bars and coin demand was to the tune of 185 tons. And the anticipation is that you could be looking at a higher number in 2024. Now, when it comes to jewelers, while of course there are higher volumes because of the price decline, and that is a definite plus for the jewelry market as well and the jewelry companies also, But there is going to be a one-time hit on the existing jewelry stock that many of these jewelers are holding, especially if this stock is not hedged or is at an open buying from the banks right now, where you pay them after as and when the prices go on a monthly basis. So in that case, the jewelers, of course, are going to take a hit onto this one. Apart from that, the markets do believe that after a very strong slash that we've seen in case of the customs duty, there could be a GST hike coming in. Remember, 18th August is a meeting for GST as well, and 3% is a special case for jewelry. Otherwise, you have 5 and 18 and 28 kind of levels coming in. So the expectation is that this 3% perhaps could be hiked to 5% or even 9% for that matter. So the next week, 10 days, you're looking at lower gold and silver prices. But if and when that GST hike does come in, then we perhaps are looking at higher numbers.
Okay, thanks a lot, Manisha, for that. Well, let's sip into a quick break on that note. On the other side, Lata will get chatting with Ashish Gupta of Axis AMC to discuss the budget announcements and their impact on the market. Stay tuned.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house.
Welcome back to our budget analysis. The budget on the face of it should have been actually positive for bonds and hence for banking stocks too. It has, after all, brought the fiscal deficit down to 4.9%. But bond yields actually fell very marginally, maybe 1 or 2 basis points in the OIS market, maybe 5 basis points. But banking stocks actually fell very sharply. To understand the budget better, from these two and other angles, I have with me Ashish Gupta, the CIO, Axis AMC. Ashish, thank you very much indeed for joining us. I'm going to start with something which was not in the intro. The F&O securities, STT, has been raised marginally. I mean, it couldn't have been raised more, I guess. I think it is 0.0625% on options, and that has become now 0.1. Does this move the needle at all?
I think it's a step in the right direction, but I think in isolation, it is not going to be adequate to what the regulators are looking to achieve. And I think multiple regulators, as well as Finance Ministry, has spoken about needing to curb the excessive speculation that is there in this area. And I'm sure they will be looking at measures to do that. But I think as a signaling tool, the increase in STT also achieves the same purpose, but in isolation, it will not be adequate.
would something more have been done, for instance, for gains made on F&O trades, a higher short-term capital gains tax? Of course, the argument has been that hardly any of them make gains, but there is a counterparty which is making gains.
Sure.
The government could have gone after them?
Sure. So I think then it becomes really an ideological issue as well, that if you are looking at different aspects of capital market income and treating them very differently. So I think there are other measures the regulators can look at. Really, this is not something that needs to be solved only through taxation.
Okay.
So there are other measures that can come in and really curb speculation and excessive retail participation.
Okay. Yeah, we have, of course, got the SEBI committee, of which you are a part of as well, and the SEBI's consultation paper is awaited. Yes. Broadly, from what is already available in the public domain, can you tell us what we should be expecting? I would assume a higher lot size is definitely on the cards. Anything else?
So I think that is in discussion with SEBI. So I would actually let SEBI come out with a discussion paper and really take it up then. So it would not be appropriate on my part to kind of second guess them.
Fair enough. But you have no inkling as to when we might expect something from SEBI?
No. So I think it should be in a few weeks is my guess.
Okay. Okay. Anyway, your job was to recommend, I guess, and then it's on SEBI's table. Okay, now let me come to the fiscal deficit reduction. It's a fairly substantial reduction. The market was deeply divided. There were at least as many number of people who thought it will be retained at 5.1%, since the government would have large expenses, at least for its two ally states, Bihar and Andhra Pradesh. And so there was an argument that it would be 5.1. 4.9 is a pleasant surprise. But bond markets have reacted only marginally. What's your sense? Where are yields headed and why a muted reaction?
Sure. So I think, first of all, I think really this for the first budget after the election. So I think it was quite important to see the direction. And I think the market broadly has taken comfort from the fact that despite this being a coalition government, there is no change and there is consistency and continuity in the approach the government has followed. Right.
Okay.
So if you look, they are firmly on the path of fiscal consolidation. The budget deficit has come down, and part of it is really attributable to the additional dividend they got from RBI. And they have actually used that not to really increase the expenditure, but to go further on the path of fiscal consolidation. So they have used the excess gain to really reduce the deficit. The reason I think bond market has not reacted more positively on this is primarily because the net borrowing target has not come down commensurately. So while the budget deficit has come down, there has been some reduction in the amount of financing that is coming from the small savings schemes, and therefore the total and also of treasury bills. So if you see the amount of supply expected to come in the bond market, that number has not changed materially.
Yes.
And consequently, I think there has been muted reaction on the bond market towards the fiscal deficit number.
Okay, no, I take your point. I think it was 4.10 lakh crore gross borrowing. It has become 4.01 lakh crore. So it's all of 9,000 crore less. One would have thought that with 20 basis points reduction, you know, something like 50-60,000 crore could have been reduced, which is not the case. I take your point on that, but would you, as a fixed income viewer now, believe that maybe the government will give up on some of its borrowing in calendar 2025? It has also been very conservative in its assessment of tax growth. I think it's just like under 11%. So is there a chance that they will do better on taxes? If you look at the April-July numbers, the tax growth is between 12 and 22%. So is there a conservatism there? There is also higher LTCG that they will collect, higher STT that they will collect. is there a chance of an overshoot and therefore, less borrowing?
So I think I find the budget maths very, very realistic and very credible. So if you look at the buoyancy in tax revenues overall, it's been expected at about 110% of the GDP growth. So I think it's a realistic number. If you see the direct tax collections you spoke about in the first few months, they have been actually running ahead of estimates.
Yes.
But indirect tax collections have actually softened, right? And in fact, in the budget estimates, therefore, you see that recalibration as well, that there has been softening on the indirect taxes. Yes, certainly capital gains and STT collections have been bumped up or are likely to be higher. But that has been repurposed towards some boost for taxation for the relatively
higher standard
income.
deduction. Yeah, fair enough. Higher standard deduction, I guess.
So that largely nets off, right? So whatever you get in high cap gain, you have given tax breaks on income tax.
All right. So what you see is what you get. You're saying there is no conservatism there. Let me come to the one where
Sorry. Just on that, I think where the surprise can come and where the government may undershoot the borrowing target is really on the expenditure side. And I think if we look at the expenditure in the first 2 months, that has been actually running well short of the run rate that is targeted for the full year. So actually expenditure will need to accelerate much more in the balance 9 months if the budget estimates are to be met. So I think while there can be an undershoot on the overall borrowing target, it can perhaps come from really underachieving the expenditure target rather than overachieving the revenue target.
That's a great point. That's a great point, really, because we have only 8 months left. And of course, revenue estimates will have to come in February 1st itself. And they may be running short at that time. Ashish, the bigger point I want to get from you is the way the budget is once again trying to use public sector banks to lend more to MSMEs. I mean, PSU banks have to build in-house capacity to assess MSMEs for credit instead of external assessment. They take the lead in developing a new assessment model based on digital footprint, higher mudra loans. Again, that also will be, the arm twisting is more possible in the PSU bank case. Is that one reason why banking stocks did badly?
Actually, I don't think so. I think really the reaction to the budget and particularly to banking stocks was, in my view, for a couple of reasons. One was the fact that there were some expectations that there will be some SOPs for deposits on the taxation front. And that did not come through. So I think maybe it's a reaction to that. The second is also really what we are seeing in earnings coming through the banks over the past few days. So there has been moderation in credit growth. There has been moderation in margins that is visible in banks. So I think that's where some of the tepidness in the banking sector stock performance is visible, but not really because of, in my view, of these budget announcements.
Okay, actually, Ashish, if you see the credit at 6 Grameen and some of the SFB, bad loan performance, why even the mighty Bajaj Finance, you can see the pressure on loan quality. And at a context like this, if you're going to be arm twisted to give higher MSME credit, when they are at SMA 1, you are going to give them more credit. That seems to be one of the reasons. Would you worry now that the credit quality cycle has bottomed out and we may begin to see more pressure on credit quality?
So if you look at the announcement of higher credit for SMA 1 credit, actually that again is going to be backed by a government guarantee model, right? So this is similar to the kind of scheme that came in post-COVID. And there, actually, I think it is more beneficial for bank credit quality rather than detrimental, that you will have support of these government guarantee programs for MSME credit. So I don't really take it negatively. But your point is valid. I think we have seen a bottoming out of asset quality cycle. We have had really a dream run in the last 3 years in terms of the kind of slippages that were visible at certain pockets, whether it is small ticket personal loans, microfinance loans. There is been an increase in delinquency, and that's been what's been visible in the numbers that have been reported by some of the banks and NBFCs.
Okay, I'm being warned I'm out of time. So very quick answer. Do you see deposit costs falling at all, or is that going to be the big bugbear for banks?
I think banks have had a clear message that they have to grow deposits to grow loans. So I think it's unlikely that in this environment deposit cost is going to come down. So
deposit cost is going to come down or go up? They will have to...
Yes, so so it's unlikely it will come down. They
unlikely.
will need to come. Yes.
Okay, sorry, I missed that. Yeah, unlikely to come down, in which case margins can be under pressure for the banking system, right?
Yes.
Okay, unfortunately out of time. I would have gone on this. Thank you very much, Ashish Gupta, for joining us on a mix of macros and markets and, of course, the banking system itself. Wrap up on Bazaar on that note. Chartfast is coming up.
This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you. The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry.
ITC surges over 3%, now up around 1.5% to a record high. The government leaves tobacco taxes unchanged in the union budget. Brokerage firms Jefferies and Macquarie bullish on the stock.
Bajaj Finance dips nearly 2% after its net interest margin declines and asset quality deteriorates in the first quarter.
United Spirits climbs more than 5% after delivering a strong set of numbers. Premiumization, cost control and contained input costs boost margins.
ICICI Pru zooms more than 5.5% as net profit rises 9% on a year-on-year basis. The retail APE also comes in ahead of estimates.
Borosil Renewables up for the second day running. Solar glass producer company zooms after the government's announcement of 10% basic customs duty on imports of solar glass.
Hello and welcome to Chartbusters. I'm National D'Souza. Joining me as always is Mangalam Malu. As we speak, the Nifty is down close to around 50 points yesterday. The bulls took it in its stride that long-term as well as short-term capital gains on equities were tweaked. Today as well, it's par for the course that the markets are holding with a bit of a cut. The good news though is that the broader markets have bounced back and the breadth of the market is firmly in favor of a number of stocks advancing and the mid-cap and the small-cap indices, all of them trading well in the green. Well, Mangalam, someone had to tell you that, the election outcome would not be as per plan. That is, what exit polls had indicated a complete majority for the BJP. And they would have told you that, in fact, you're going to see a tweak in the equity taxation. And you'll say that the market still is near record highs. You would have said you're bluffing. But that's the way it's panned out.
That's the way it's panned out. That's the cult of the equity market. And that's the resilience that we've seen, the kind of flows that have been coming in from domestic investors in our market itself. And that's kept, the story higher despite what one would perceive as negatives for the market from a market standpoint itself. Though a lot of stocks are spiking as we speak. LIC, for instance, up around 4%. We are seeing some traction in, names like Anantraj, which is up around 3.5%. Liberty Shoes is another one. Footwear industries have been seeing a bit of an uptick over the last couple of trading sessions. BSE itself is up about 6%. And Ethos, that's the one that should come up for you, up around 10%. Long-term capital gains tax, short-term capital gain tax on all sorts of investments. But if you're buying a Rolex, the returns on the Rolex over the last 4 or 5 years have been actually higher than the markets without any tax if you're reselling that product itself. So we'll keep an eye out on Ethos as well. That stock up nearly 10%. And another one that actually stands out is Anthony Waste Handling. It's up nearly 35% in this week itself. The first 3 trading sessions of this week. Remember, Anthony Waste Handling, we had the management joining us on the show last week. They spoke about 20-25% revenue CAGR going forward. At the same time, the kind of order book that they have, over 8,300 crores. So all of that doing well for Anthony Waste Handling. Take a short, in fact, we have with us Sony Patnaik of JM Financial Services joining in with a quick technical check on the market. Sony, seems like mid-caps continuing to do well even as the large caps see some bit of consolidation.
Hi, good morning, Mangalam, Nigel. Thank you for having me on the show. Yes, definitely. I think mid-caps and small caps are certainly performing or holding the rather broader markets as we speak. Nifty also is holding on to its support on a closing basis, 24,400, 24,350. That range is quite critical. It is holding that support on closing basis. For as long as it's defending that, you can see a consolidation in Nifty as well. On the higher side, 24,600, 650 can act as a resistance. So it's mostly like to consolidate in this range for the next 2 to 3 days where the rollovers take over Nifty. I think Bank Nifty is a bit of a worry over here because Bank Nifty has closed below 52,000 yesterday. It broke that crucial support and Bank Nifty is not able to take out the resistance above 52,000 on today's weekly expiry. So anyway, Bank Nifty may continue to drag the broader market or the indices lower. If it's breaking 51,000, you can even see levels of 50,000 in Bank Nifty. perhaps it can happen for the August series. To negate this view, Bank Nifty has to take out and close above 52,000 today and tomorrow. Then only, the view can get negated and it can hold on to its support as of now. But for now, I think it's better to stick to stock-specific strategies with good breakouts and good volume option. When it comes to indices, it's better just to hedge the positions and stay light.
Okay, all right. Thanks for that, Sony. What about individual stocks? What are you looking at?
The first would be in IGL, which is seeing a good range breakout today with good long built-up positions and also good rollovers for the July to August series on a longer side. So in August series, one can buy IGL futures, keeping a stop loss of 540 and a target of 562, 565 can be seen. The second stock pick is from the pharma space, PEL, which is also looking for a good range breakout. It's consolidating right now, but above 950, you can see that breakout coming in PEL. So one can buy at current levels, keep a stop loss of 920 and a target of 980. Above that, 1,000 targets can be seen for August series.
All right, take that point. Do you have a view on any of these cash stocks which are doing extremely well? Case in point, something like a BSE. We are seeing some traction in LIC as well. Anthony Waste Handling, as we spoke about earlier. Are you looking at any of them?
Definitely, Mangalam. I have been noticing LIC, which is looking quite strong even as we speak. And, the stock has given a fresh breakout. And above 1100, it has crossed these levels. So anywhere towards 1160, 1180, it can test. If somebody has already bought it at lower levels, it's wise to just trail the stop loss to 1060, which is its very crucial support. Hold for higher targets of 1180. Even if it's able to sustain above 1180, these targets can get extended to 1230. So on charts, it has given a very fresh breakout and looks quite strong to hold.
All right. Thank you, Sony, for joining in. With that, we'll slip into a short break. Come back on the other side. We'll have the management of Indian Overseas Bank. Ajay Kumar Srivastava, who's the Managing Director and CEO, joins in to discuss the quarter gone by.
At the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
And what a great way to celebrate our own 25th year, with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and CNBCTV18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour, live on YouTube at CNBC TV.
Welcome back. You're watching us here on Chartbusters. One of the stocks which is busting charts this morning has been United Spirits. It's a big mover. In fact, it's a fresh record high that we're seeing on the stock, up around 5% upwards of that 1400 mark on the stock price as well. And that's largely because of a strong operational performance coming in. Premiumization, cost control, and at the same time, better realizations for them has actually aided their performance. So revenues coming at 2,350 crores against CNBC TV 18 poll of 2,330 crores as well, largely in line. But it was the EBITDA which was higher by almost 60 crores as compared to the poll. EBITDA came in at around 458 crores. The street was working with a number of around 400 crores. And we have the margins which are at a multi-quarter high at 19.5%. This compares with 17.3%. These are standalone margins. Remember, the first quarter margins on a consolidated basis are reportedly a lot higher because of the IPL business as well. So a core margins at 19.5% are much higher than what we've seen in at least the last 12 or 13 quarters. Profit after tax, again, closer to 300 crores versus street expectations of 238 crores. What did well for them? The prestige and above business actually saw a revenue growth of nearly 11% versus street expectations of 8 to 9%. And remember, this was a quarter which was marked by a fair amount of election-related disruption as well. And in that, the volumes grew by about 5.1%. Popular, a business which they decided to, degrow or curtail, has actually seen a decline of about 2.4% in value and about 4.6% in volumes, largely expected. And they've also gone ahead and made 2 acquisitions. And that's an interesting one because over the last couple of years, they've gone ahead and bought a lot of these artisanal brands. And this one, again, is an investment, a 15% stake in V9 Beverages. V9 Beverages, Nigel, makes distilled non-alcoholic beverages under this brand called Sober. And the other company that they've bought is a 25% stake in this company called Coffeen, which they've put 5 crore rupees. What is it that they make? Specialty cold brew coffee liqueur. Both of them do revenues of about 50 lakh rupees as of last year. But then again, with United Spirits distribution and their might ahead, maybe they can scale it. But interesting foray there.
Well, that's right, Mangalam. Budget, no budget, good times, not good times.
Everyone's going for a bit of
a large one, I think.
Whether you go in for a large one, you go in for a small one, you got to protect yourself, and that's exactly where the next stock on our radar comes in from. ICICI Prudential Life. Also, quarterly results coming in. The stock among the top F&O gainers. Yash joins in with the fine print. Yash, what's insuring one's life?
Well, for ICICI Prudential Life Insurance in the first quarter, there were some hits, some misses, but the market clearly acknowledging how the hits were much stronger than those few misses which came in the first quarter fine print. If I just have to look at, what CNBC poll had suggested, the new business premium which the company collected had come in line. Total APE was a miss and VNB was a miss, but the market, acknowledged the fact that retail APE, which is more margin accretive, was a strong beat when it came to CNBC TV 18 poll, and the margins importantly came in line. If you have to look at the year-on-year numbers, the new business premium grew at a healthy pace of 24%. Total annualized premium equivalent or APE grew at 34%. Retail APE, the one which came at a strong beat, grew at 57% in the first quarter. VNB grew at 8%. And finally, the margins, they grew. They were at 24.04% versus 30%. Now, it's been an industry where margins have been taking a strong beating downwards because of the strong ULIP sales which have come about because of the buoyancy in the capital markets. But ICICI Prudential Life could maintain their margins to what the street was anticipating, and the street is liking that fact. The stock hasn't done much as compared to some of its peers in the sector. It's up 13% in the last 1 year, 12% in the last 3 months. It's just about 52-week high at 674, marching towards that point. Trades at about 1.9 times price to embedded value, not the most expensive one in the particular life insurance sector, and that is giving some valuation comfort as well.
Okay, thanks a lot for that, Yash. So ICICI Prudential and United Spirits, both of them doing pretty well in today's trading session. An hour or so ago, all the real estate stocks are doing well, barring DLF. And now that one as well has recovered from the low point of the day. If I'm not mistaken, it was down 1.5%. Now it's up 1.5%. So in the last 30 minutes or so, DLF, after starting off in the red, that's pulled back considerably. On the flip side, take a look at India Cements. That stock has suddenly moved to the low point of the day. So, there's been that excitement that maybe there could be a battle between two large names for this particular asset, or maybe Ultratech Cement goes the entire hog and pulls up, and their open offer. But for the time being, that stock is under some pressure. And V-Mart as well, the other big mover in this month, well, that's come in for some profit taking, moving to the low point of the day. Well, time to slip into a short break. On the other side, we'll try to get chatting with the management of Indian Overseas Bank. Stay with us.
Nights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Skill loan scheme will be revised to facilitate loans up to 7.5 lakh rupees with a guarantee from a government-promoted fund. This measure is expected to help 25,000 students every year. Education loans for helping our youth who have not been eligible for any benefit under government schemes and policies. I am happy to announce a financial support for loans up to 10 lakh rupees for higher education in domestic institutions. E-vouchers for this purpose. E-vouchers for this purpose will be given directly to 1 lakh students every year for annual interest subvention of 3% of the loan amount. We will also support development of road connectivity projects, namely 1. Patna-Purnia Expressway, 2. Buxar-Bhagalpur Expressway, 3. Bodh Gaya, Rajgir, Vaishali and Darbhanga spurs, and 4. Additional 2-lane bridge over River Ganga at Buxar at a total cost of 26,000 crore rupees. Power projects, including setting up of a new 2004.
Welcome back. Well, as promised, let's get chatting with the management of Indian Overseas Bank. We have with us Mr. Ajay Kumar Srivastava, who's the MD and CEO of the company. Hi, Mr. Srivastava. Good morning, and thanks a lot for joining in. Well, I want to focus first on the deposits. There appears to be a bit of a slowdown out there in the system on the whole. And in fact, deposits in the system are declining. What kind of deposit growth are you looking at?
Yeah, the entire industry is grappling with deposit growth, and the same is true for IOB also. We are looking at around 10 to 11% of deposit growth in this financial year. And if you look at the Q1 figure, we have grown by around 4% in Q1. And yes, please.
Yeah, so 10 to 11% deposit growth in this year when, the deposit growth in the entire system is declining. I just wanted a couple of thoughts. One is that what is your cost of deposits likely to be for you to be able to grow deposits by about 10 to 11%? How much is that likely to increase by? And if that were to increase, what happens to your NIMs?
Yeah, cost of deposit as of today 4.95 for June quarter. We intend to keep it around 5, maybe plus 5 also, around 1 or 2 bips above 5, because that is the situation in which we are in. Having said that, the deposit growth which we are targeting of 10 to 11%, we have a plan already in place. A special retail term deposit of 444 days we started almost 20 months back. We envisaged and we imagined that there is going to be a scarcity of deposit growth. And accordingly, we formulated plans and started implementing it almost 20 months back. And in that 444 days bucket, which we started 20 months back, we have already garnered around 45,000 crores over last 18 months. And in the month of February this year, we increased that rate of interest to 7.30, which happens to be the best in the system. And for 1 year in our recently concluded ALCO, we made it 7.10. So that part is taken care of, that is retail term deposit. And for CASA, if you see, year on year, we have grown by almost 10%. And in Q1 also, we have been able to maintain the amount. Amount-wise, it can be termed as flat, but we have not gone down as compared to the industry. So plans are in place, and for CASA, last year, onboarding of customers was the priority. We onboarded amount around 2.5 million, around 25 lakh.
We get that. We get that you are putting plans in place to increase your deposit, but the question is what happens to your margins with increased cost of deposits? 4.95% you said can go upwards to 5%. You're giving interest worth nearly 7% as of February when you restructured that. So what happens to your NIMs? Because in this quarter itself, it saw a big decline both year on year and quarter on quarter. What is the range that one should work with?
Yeah, the decline has been because of one special entry in Q4 of last year. Because of that, the decline is visible. But having said that, the cost of deposit will be compensated by the pricing which we are going to give to our borrowers for further lending. And the range of sub 8 or around 7% lending, that has gone by. We are very, very particular that what pricing we are going to do as far as lending is concerned. So whatever additional cost we are going to incur by increasing deposit rate, we are going to compensate by interest income and other non-interest income also. And accordingly, we are looking at to maintain NIM at around 3.10 for this year.
All right, 3.10. Got that, Mr. Srivastava. A couple of quick questions then. You're saying the deposit will grow by 10 to 11%, but in the first quarter, it's only 4%. You're confident that you can grow at 12%, right? From year on, because that's the asking rate.
Exactly. Anywhere between 10 to 11, yes.
Got it. And you also said that the cost of deposit will go up, but you'll offset that by getting your loans priced at a better rate. So that brings me... What is it?
Increase in CASA, low cost.
Increase in CASA, correct. Now, if your yields that you're offering to your customers go up, what kind of loan growth are you looking at? Don't you think it'll be a bit of a dampener as well?
There is huge demand. That is what I can say. Credit demand is there in all sectors, right from retail or MSME or even corporate sector also, demand is there. And there is not enough money in the market. So borrowers are also tuned to this fact that a little bit of higher pricing they have to bear with. That is one part. And accordingly, the credit growth also we are looking at around 10 to 11 and 12% only. This year, the plan of the bank is, of the management is that we will try to grow deposit more than credit growth. That is the plan for this year.
And what's the loan growth target for this year?
Around 12%.
12%. All right. Let's talk about your asset quality then. Could you tell us what kind of recoveries are you factoring in the IBC NCLT cases in FY25?
Yes, recovery, I will take both slippages also. First, I will take 10 seconds about conveying about the slippages. So if you look at Q1 figures, our slippage ratio is only 0.13. We have slipped only 277 crores, and last over 15 to 18 months, the slippage in corporate sector has been nil. Not even a single corporate account has slipped. This shows about the type of credit underwriting we are doing and the level of monitoring efficiency that has come into the system. Last year, for the full year, the slippage was only 1,487. Slippage ratio was 0.87 for last year. This year it is 0.13. That is one part of asset quality. The second part comes of recovery. This quarter we have recovered 582 crores. Going forward, the exact, I will say, amount-wise, that an NCLT and non-NCLT, how much we are going to do, it's difficult at this moment. But having said that, we are targeting 5,500 crores worth of recovery, and one of the great sources of recovery is going to be ARC sale. We are very bullish on that. In the month of April itself, in this financial year, we started ARC sale. We 13,000 crores of assets we put on block, and due diligence by many ARCs is going to happen. So we are pretty confident that overall, by the year end, we will be able to recover more than 5,500 crores of bad assets recovery.
All right, that's a tall target, 5,500 crores. And finally, before we let you go, if you could give us a sense of what your credit costs for this year would be, along with GNPA and net non-performing assets?
Credit cost for Q1 was 0.29. We will try to keep it around 0.75 to 0.80, less than 1, of course. And GNPA, we are at 2.90. We intend to bring down by another at least 40 bips in this financial year, maybe around 2.40 to 2.50. Net NPA, we are at 0.51. We are already, I will say that net NPA ratio is one of the best. But still, the year-end budget is around 0.25 to 0.30.
Got it. All right, Mr. Srivastava, always good speaking to you. Thanks a lot for joining in. You've given us a good outlook in terms of your numbers, and we'll hold you to them in your next quarterly update as well. Wishing you a good day and a good quarter ahead. For the time being, the stock holding with a gain of around 1.5%. Well, on that note, we'll wrap up on this edition of Chartbusters. You stay with us, though. Trading Hour comes up next.
Power plant at Peer Painti will be taken up at a cost of 21,400 crore rupees. New airports, medical colleges and sports infrastructure in Bihar will be constructed. An additional allocation to support capital investments will be provided. The requests of Bihar government for external assistance from multilateral development banks will be expedited.
This budget, after a few budgets, is a bit more negative, I would say, on the taxation front in particular. There was some expectation that long-term capital gains tax might be increased, but with indexation benefit. So today what we've seen is that there isn't an indexation benefit, and plus it, I think, increases the risk. In a way, there was a stability in the capital gains regime for the last several years. Now the long-term gains tax has been raised by only 2.5%, short-term raised to 20%, but this increases the risk in investors' mind that it could be not a a given tax regime for next many years.
Budget priorities. The people have given a unique opportunity to our government to take the country on the path of strong development and an all-round prosperity. In the interim budget, we promise to present a detailed roadmap for our pursuit of Vikasit Bharat. In line with the strategy set out in the interim budget, this budget envisages sustained efforts on the following 9 priorities for generating ample opportunities for all. Number 1, productivity and resilience in agriculture. Number 2, employment and skilling. Number 3, inclusive human resource development and social justice. 4, manufacturing and services. 5, urban development. 6, energy security. 7, infrastructure. 8, innovation, research and development. And 9, next generation reforms. Subsequent budgets will build on these and add more priorities and actions. A more detailed formulation will be carried out as part of the economic policy framework about which I will speak later in this speech. This budget details some of the specific actions to be initiated in the current year towards fulfillment of these priorities, with potential for transformative changes. The budget also covers some of the previously made announcements with intent to strengthen them.
Good morning. It's the day after. You're watching Trading Hour. I'm Reema Tendulkar, and with me is Surbhi Upadhyay, and it just feels business as usual. Large caps are consolidating. The activity, the rally in the mid caps continues, even though there are so many voices who are pointing out that the mid caps are expensive. It's trading at a 50% premium to large cap. But look at the mid cap index. Look at the small cap index. The advanced decline ratio has 4 stocks gaining for 1 stock declining.
Absolutely, Reema. I mean, the market's really moved on. I think it started moving on yesterday itself. The only thing is that the fall in the bank stocks is a bit telling. Once again, even this was the same picture yesterday. Remember, the bank Nifty was one of the weakest spots of the market, and that's continuing. So there's follow-on selling in banks. And that's a little bit of a spot of a bother. You can't take your eyes off that. So even today, so Bajaj Finance has a reason. It's reacting to numbers, and those margins are lower than expectations, etc. But look at the banks. Axis, ICICI Bank at this point in time, State Bank of India, Indus and HDFC Bank. There's across the board selling coming in. So from the bulls' perspective, this is going to be a bit of an issue.
Axis Bank, by the way, reports numbers
today as well. Yeah, exactly. So let's see. I mean, if the numbers can, part the clouds to an extent. And
because so far it's been a mixed bag. HDFC Bank was fine, pretty okay. Kotak disappointed the streets. So Axis Bank will be the third large cap private sector bank to report numbers.
Absolutely. So we'll watch out for that. The other trend that stands out today is that once again, just like what happened, you remember on counting day, that on that day, FMCG rallied, but there was no follow through. So once again, if you look at stocks this morning, Lever is down. Despite pretty decent numbers, you're seeing that play out on some of the other names like Nestle, Britannia. A lot of these stocks are also on the lower side. So FMCG is not seeing the follow through. So what is rising then? Well, you've got ONGC in leadership position, Coal India, BPCL. There's, of course, Reliance that's really helping. ITC is still celebrating the fact that there's no further increase in tax on cigarettes. But I think, Reema, the PSU side of the market, yesterday they were down and out. Today they're saying, hey, we're back.
We're back. The Nifty CPSE index should come up for you on your screen, and that's up nearly 1.5%. But let's get down to business then. Shibani Sarkar Kurian from Kotak Mahindra AMC joins us on the show now. Shibani, it's absolutely outstanding, right? The way the markets recovered after election day. Yesterday, perhaps there was a little bit of a wobble, maybe for 1 hour or so, when the markets fell 500 points in the Nifty. But after that, it recovered and it's holding. And we keep going back to that example in 2018 when there was the first increase in LTCG. Markets did correct, not on the day, but with a lag, there was a correction seen in the markets. Do you think, how would you read the near term for the markets now post the budget?
Hi and good morning. Yes, if you look at the budget, there are lots of positives that the market is taking away. I think the biggest positive that has come through from our perspective is that the fiscal consolidation priority continues to be maintained. And if you look at a consolidated fiscal deficit, which is both at the center as well as at the state, the number seems to be coming down. And going into FY26 with a 4.5% central fiscal deficit expected, that number is likely to come down further. So that bodes well from both a borrowing perspective as well as with hopes of a rating upgrade, because a lot of the external rating agencies look at debt to GDP ratios as well as consolidated fiscal deficit. So I think that's one big positive from a budget, which the market is possibly taking on board. The second factor is that the budget does a balancing act between both investments as well as spurring some amount of mass consumption with some of the tax changes that have been brought about, as well as the fact that if you look at on an overall basis, with both on budget as well as the IEBR expenses in terms of capital expenditure, the growth seems to be fairly strong over the revised numbers for FY24. So I think that's another key factor that the market is looking at. Of course, from a near-term perspective, I think the tax changes, especially by long-term capital gains as short-term capital gains as well as STT, that's a bit of a dampener for the market. However, remember, there have been tax changes across all other asset classes as well. And if one has to look at a silver lining, the tenor for long-term capital gains tax has not been changed, and that's still 1 year. From a market perspective, in the short term, I think market just goes back to focusing on earnings delivery. We are in the middle of the first quarter earnings season, and so far numbers have been somewhat muted if you look at the overall aspect, especially because of OMCs as well as metals. But X of that, numbers have been largely in line with estimates. So I think now it's back to business as usual, looking at earnings and valuations now that the policy direction has been set by the budget.
All right, fair enough. So those are opening thoughts and your take on the budget, Shibani. Let me just draw your attention to this constant selling in banks, right? Now, we're just trying to figure out whether there's anything additional in the budget yesterday that's compounding the selling, or whether it's banks reeling under their own known issues, right? We know deposit mobilization has been difficult. And I don't know if this 12.5% LTCG, whether that's going to make people, leave their money in the bank deposit and not put it in the market. That seems highly unlikely, right? But just your sense, because the selling is quite excessive. And this results season hasn't exactly, thrown up too many positive or sort of bright points with respect to banks.
So absolutely, Sylvie. I think the biggest factor to monitor where banks are concerned is the pace of deposit mobilization. Banks, as you know, over the last few quarters have seen pressure on net interest margins, primarily because cost of deposits have been rising. And there's also been repricing of the past deposits, which has led to this pressure that we have seen in terms of margins. Deposit accretion does continue to lag credit growth. And I think that at the margin, we have to take that into account when we are looking at the overall earnings as well as return ratios for the banking system. Now, if you look at last few quarters, there has been some uptick in terms of deposit mobilization, but it is still not enough. And therefore, the expectation is that the credit deposit ratios for banks would possibly moderate, which will have a bearing on margins. However, on the positive side, when you look at the cost of deposits seem to be largely stabilizing. Banks are now looking at better productivity in terms of their own branch network to raise liabilities and not just looking at the cost front. So from that perspective, I think margins should start to stabilize over the next few quarters. If you look at the large private banks are still holding up in terms of both their ROA, ROE profile. Margins seem to be, again, as I said, possibly bottoming out, and valuations are in your favor. So in the entire BFSI pack, we think that some of the larger private banks seem to be well placed, specifically with respect to their valuation as well as return ratios, and risk reward is in your favor at this point in time. But we'll have to wait and see for the next 1 or 2 quarters in terms of the margin trajectory for some of the re-rating to possibly start. And of course, the ownership level across most of the large private banks is high, specifically where some of the domestics are concerned, and even the FII ownership, while it has come down, still remains high. And that could be another reason, which is why, the sector has seen the kind of pressure that it continues to see.
Any other changes that you would recommend in your portfolio? You have to keep rebalancing your portfolio. Some things come in, some things go out. So take us through the changes for the next 6 months. Which is the sector which, according to you, might lead? You spoke about financials in details, but outside of that?
Yes, so, there are 2 sectors that we are incrementally evaluating where, again, we believe that risk reward is in your favor. One, you alluded to the consumption space. Of course, the big bang expectations that, we went in terms of the budget, providing a lot of support to the consumption sector. Maybe some of that has not played out. But if you look at the fine print, there is adequate support which has been given to the middle class and to the rural segments in order to spur consumption. That, along with the fact that monsoons have been fairly normal as of now, and at the margin we do expect that agri, especially the kharif output, should be a good one, along with input cost pressures coming down, which would mean that the rural wages, especially on the real rural wage perspective should start to improve. And therefore, if you look at consumption, especially with respect to valuations and their history, that sector looks to be fairly well placed. So that's one segment that we, incrementally are positive on. Banks we already spoke about. And the third aspect that, where risk reward seems to be in your favor, especially where valuations are concerned, is possibly the large cap tech names. Again, the commentary from most of the companies that have reported numbers seems to suggest that a lot of the pressure that you are seeing, especially on terms of discretionary demand spends on the BFSI space in particular, seems to be bottoming out. North America is seeing some revival, which is also what the commentary seems to suggest. And therefore, that's the other sector that we are evaluating.
So IT, consumption, and overall on banks, you're not trimming positions, despite all the concerns you laid out, right, Shibani? What's the overall stance on banks?
So banks, Surbi, we are positive, specifically on the larger private banks, where we think that, valuations are in your favor. So the large cap private banks is where we are positive on.
Thank you. Great conversation, Shibani. We look forward to the next one. Get into a break on that note. But, getting incrementally bullish in technology gives us our cue to invite the management of Zensar Tech, which reported their numbers recently. Good top-line growth of more than 4%. We'll discuss the way forward with Manish Tandon on the other side.
Their implementation for expediting our journey towards the goal of Vikasit Bharat. Our government will undertake a comprehensive review of the agricultural research setup to bring the focus on raising productivity and developing climate-resilient varieties. Funding will be provided in challenge mode, including to the private sector. Domain experts, both from the government and outside, will oversee the conduct of such research. Release of new varieties. New 109 high-yielding and climate-resilient varieties of 32 field and horticultural crops will be released for cultivation by farmers. Natural farming. In the next 2 years, 1 crore farmers across the country will be initiated into natural farming, supported by certification and branding. Implementation will be through scientific institutions and willing gram panchayats. 10,000 need-based bio-input resource centers will be established. This year, I have provided 11,11,111 crore rupees for capital expenditure.
Welcome back. Let's move the conversation now to Zensar Tech. They reported their numbers on Monday post-market hours, but yesterday, with all the budget-related announcements, we didn't get a chance to chat with the management. A quick recap of the numbers: strong top-line growth. The company's reported an over 4% revenue growth, 4.3% constant currency quarter-on-quarter. Margins, though, have declined because one of their clients went bankrupt, and the company has taken a provision of 110 basis points on the margins because of the bankruptcy of the client, and therefore their profits too have come down by nearly 9% quarter-on-quarter. Manish Tandon, Managing Director and CEO at Zensar Tech, joins us on the show. Manish, morning. This is Rima here. First, on the top line growth, 4.3%. this bankruptcy of the client, you've explained impacted your margins, but did it also impact your top line? And what can you guide on revenues going forward? Because in the conference call, you sounded a bit cautious.
Yeah, so first of all, on the bankruptcy of the client, this has not impacted our top line because the client was relatively small, about $1 million in per quarter. And we, as per Chapter 11 laws, any work that we do post the announcement of bankruptcy is covered. The revenues from that are covered. And also we are one of the critical vendors and the chair of the creditors committee. So there is a chance that we might be able to collect more than what, at least some amount that out of the total outstanding.
So what is the outstanding?
1.7 million.
1.7. Okay.
About 1.7 million or so, 1.1% of revenues is the outstanding. And on future, I think, again, we don't give future guidance, but there are, as usual, there are some headwinds and there are some tailwinds. Headwinds are that one of our TMT clients has announced a furlough in July, which is something new. So that was not anticipated. Also, the second thing that I'm seeing is because of this, I'm anticipating that because of this CrowdStrike thing that has happened last week, we might see a diversion of funds away from existing large projects to a little bit on the beefing up on the security and the robustness of the IT infrastructure. Now, this has happened in the past, and I am anticipating that we might see something there. So those are the headwinds. The tailwinds continue to be that our businesses seem to be doing okay. This was the second quarter in a row where all our verticals actually grew sequentially. And that is a positive sign. So as I said, I mean, you have to balance the headwinds and tailwinds and see where you land up.
A fair point, Mr. Tandon. It's been a challenging start, and from what you say, all the challenges aren't over yet. So all things put together, now you have this other client that's going into furlough from July. I think you also have a wage hike coming in that will be effective July. So should investors be prepared for more sluggishness on the top line? Also the margins, we just put out a graph that Rima had shared with us. Overall margins have been on a declining trajectory from 18%, I mean sub 16%. So will we see more of this before things get better? How, the outlook, given what you're saying, seems like it's going to be more sluggishness in Q2, Q3 perhaps.
So the margin chart, if you look it up and if you adjust the margin for a one-time bankruptcy, then our adjusted EBITDA margins this quarter is 16.3%, which is in line, actually 15 also is in line with the mid-teens guidance that I have been giving in the past. Last year, our margins were a bit higher because we wanted to invest in growth. And as I said, we've tried to make sure that we have balanced growth between revenue growth and margin growth. So that is where, as stated previously to the investors, margins will be in the mid-teens range because we are going to invest for growth. And it's good to see that some of those investments are bearing fruit. Sequentially, Q4 to Q1, 4.3%.
But sir, are you confident of growth? I take your point that you've sacrificed margins a bit because, I mean, that growth number, the top line number is no doubt looking very good. But are you confident of top line growth given all the headwinds? The furlough, the other client which has gone into bankruptcy, this CrowdStrike business, I mean, this is a fresh issue that you described. Could Q2 actually be flat?
I'm cautiously optimistic. Let me put it that way. But again, the game isn't over till the final whistle is blown. So we will see where we'll end up. But I'm cautiously optimistic that we will continue to have revenue growth.
Have you had any initial conversation with clients about moving some work away from the large projects to beef up the internal security at enterprises post the CrowdStrike outage that we had? Because you alluded to it as a potential headwind. So what are initial conversations like? Why are you so fearful this might happen?
To be frank with you, this happened just last weekend. In fact, even my flight got cancelled. So it's too early to have those client conversations because everyone is busy with the disaster recovery thing. In fact, Zensar teams have received a lot of commendation from clients because of our performance in helping them recover from the situation. And there's a particular city out there where even the police department has given us a glowing reference for the work that our team did last in helping them recover this thing. I am just basing this on what I have seen in the past. As you know, I have been in the industry for 30 plus years now. So what I have seen in the past, I'm basing it based on that rather than on client conversations.
Okay, and what happened in the past? If history has to rhyme?
What happened is exactly what I said, that when a major security incident or a DR incident happened, you see a shift away from capital projects to more of beefing up of the security and DR infrastructure.
Big impact? Are we talking about large sums being pulled out of projects, existing projects?
Large is a relative number. So we have to, for a large company, it will be large sum. For a small company, it will be a smaller sum.
But across the board impact, that's an important one and something that, we'll take it forward even with our other conversations with a lot of the IT companies. Let's see how this plays out. Thank you for joining us, Mr. Tandon. Good conversation, and we wish you good luck for the rest of the year. That's a conversation from Sensar. Frank, they've had an issue with one client in this quarter, maybe some more headwinds ahead as well. Stock, however, is holding up. It's done well in the last 6 months, still holding up today. Let's take a break on that note. We'll come back on the other side. And we will be in conversation with Mitesh Thakkar. Let's see what trades you can work with this morning.
This would be 3.4% of our GDP. Infrastructure investment by state governments. We will encourage states to provide support of similar scale for infrastructure, subject to their development priorities. A provision of 1.5 lakh crore rupees for long-term interest-free loans have been made this year, also to support the states in their resource allocation. Coming to personal income tax rates, I have two announcements to make for those opting for the new tax regime. First, the standard deduction for salaried employees is proposed to be increased from 50,000 to 75,000 rupees. Similarly, deduction on family pension for pensioners is proposed to be enhanced from 15,000 to 25,000 rupees. This will provide relief to about 4 crore salaried individuals and pensioners. Second, in the new tax regime, the tax rate structure is proposed to be revised as follows. 0 to 3 lakh rupees, nil. 3 to 7 lakh rupees, 5%. 7 to 10 lakh rupees, 10%. 10 to 12 lakh rupees, 15%. 12 to 15 lakh rupees, 20%. And above 15 lakh rupees, 30%. As a result of these changes, a salaried employee in the new tax regime stands to save up to 17,500 rupees in income tax.
Welcome back. Well, let's straight away head across to Mitesh to figure out what trades you can perhaps look at. Mitesh, good to be speaking with you. So it's the day after. What do you make of things? Banks are still feeling a lot of pressure, but the broader markets bounce back. So what trades now?
So we have raised a very important point. The bank Nifty has, started trading below 51,450, 500 levels. That's a negative. And, there is mild support at 51,000, but I think it can go to about 50,500. So it is the banking pack, which is putting pressure on the Nifty. And in fact, today morning, I suggested don't trade the Nifty because the bank Nifty could, turn out to be the weaker spot and which also enjoys a significant weightage in the Nifty. So I think that's playing out. And therefore, clearly avoid the indices, or, you may want to take some selling some out of the money call options in the banking names, or even buying put options. I think both of them is okay. And disclaimer that we have some put options positions for the August expiry in the bank Nifty. So we have a negative view. On the stock side,
more downside.
Yeah.
No, go ahead. Go ahead.
So I said on the downside, I think Sun Pharma is something, which is showing, on the stock side, Sun Pharma is, which is showing some kind of positive traction. So buy here with a stop at 1597. Look for a target of 1650, 1660 to begin with. We may eventually look at higher levels. And the other stock which I have is IndusInd Bank, which is a sell with a stop at 1414 is the stop loss and a target of around 1365, 1361.
Okay. Thank you very much for that. The fall in banks is concerning, and Mitesh is pointing out there is more downside in store. The Nifty Bank could go down to levels of 50,500. Right now, a Kotak Mahindra Bank, State Bank of India, these stocks are all at the day's low. So the selling continues. Even an HDFC Bank has extended its fall. Thank you for joining in, Mitesh. We need to get into a short break. We'll come back with more.
Apart from these, I am also making some other changes as given in the annexure. As a result of these proposals, revenue of about 37,000 crore, that is 29,000 crore in direct taxes and 8,000 crore in indirect taxes will be foregone, while revenue of about 30,000 crore rupees will be additionally mobilized. Thus, the total revenue foregone is about 7,000 crores annually. Bihar has frequently suffered from floods, many of them originating outside the country. Plans to build flood control structures in Nepal are yet to progress. Our government, through the Accelerated Irrigation Benefit Program and other sources, will provide financial support for projects with estimated cost of 11,500 crore rupees, such as the Kosi-Michi intra-state link and 20 other ongoing and new schemes, including barrages, river pollution abatement, and irrigation projects. In addition, survey and investigation of Kosi-related flood mitigation and irrigation projects will be undertaken. Assam grapples with floods every year by the Brahmaputra River and its tributaries originating outside India. We will provide assistance to Assam for flood management and related projects. Himachal Pradesh suffered extensive losses due to floods last year. Our government will provide assistance to the state for reconstruction and rehabilitation through multilateral development assistance. Uttarakhand too suffered losses due to cloudbursts and massive landslides. We will provide assistance to the state. Recently, Sikkim witnessed devastating flash floods and landslides that wreaked havoc across the state. Our government will provide assistance to the state. Andhra Pradesh Reorganization Act. Our government has made concerted efforts.
Welcome back. Well, it's the tax and capital market discussion full throttle, because not in the recent past have we had a budget that is so heavy on taxation that directly impacts the capital market. We've got changes in STT, we've got changes in the long-term capital gains tax regime, as well as, of course, what's happened with buyback. So let's discuss all of this one by one, and we have a full house for that. We have Mr. Dheeraj Relly, MD and CEO at HDFC Securities, who's, of course, representing the broker fraternity. We have Deepak Shenoy, founder of Capital Mind, who's the voice of the investor. And we have Girish Vanwari, founder of Transaction Square, who's the tax expert, of course, on the panel. Gentlemen, thank you very much for joining in. Great to have you on. I want to start with STT, because yesterday all the limelight was being hogged by, I think, buybacks and LTCG. So on STT, Mr. Relly, if you could open the floor, because I think going into this budget, the whole hype and hoopla was around curbing speculation. The STT hike has come in on futures and options. It's a big hike, I think as much as 60%. What's the impact?
So first of all, I want to clarify everyone that this hike will be applicable from October 1st and not with immediate effect. So that's something, there was a confusion yesterday, but now we have a clarity on the same. You're right that this is a significant increase in the transaction cost for the traders and investors. So to that extent, it will have its own impact on the volume. We did some maths to check how much will be the impact. If on sale of securities, options, you will have impact of almost 50%. And if we include sale and purchase both, because STT is applicable only on the sell side and not on a buy side, the impact will be almost 21%. So 31% impact on the sell side of the transaction, 21% impact on the sale and purchase both leg of the transactions. This is in the case of sale of options in securities. If we talk about the futures, I think the impact is slightly higher. Impact is 50% on sell side of the transaction. And here the STT is charged on the contract value. And in case of options, it is charged on the premium. If we include sale and purchase both transactions, the impact will be 39%.
Okay, so could you just, for our benefit, repeat the numbers, I think, and let's start with options, because that's where the whole discussion is. On options, you're saying that it's 31% and 21%. Is that right?
Yeah. So let's look at option premium of premium value of 1 crore. In the 1 crore, the transaction charges will be 4950. That will remain the same. We are assuming that the transaction charges will remain same. In fact, you must notice that this is also up for a revision effective October 1st. This will revise downwards, but we don't have any visibility as of now. That's where, for the purpose of calculation, we are taking 4950 per crore as the same charges for the exchange charges. And we are keeping all other charges same, not taking any charges impact of the brokerage. So we are just calculating the impact of the STT only. So STT on 1 crore premium value earlier in the old taxation was 6,250. Now it will move to 10,000. So this would translate into an impact of 31%. And if we include both sides of the transaction, sell and buy, this will be an impact of 21% because the charges will remain on the buy side of the transaction, which is 6163 per crore.
So Girish, you have a pulse of the market. You speak to all the clients who trade with you all and do brokerage. Do you think it's a sizable increase we're talking about? Will it curb speculation on F&O, to your mind?
And this is not the only thing. There are three things to be considered. First was the size of the F&O, which got increased, SEBI's proposal to make from 5 to 25. Second was the margin trading restrictions of 1,000 stocks, which could not be pledged. And third is this. You add the three up, people are nervous. And today I was just speaking to people. Today, if you sell, square off your positions, if you sell your MTF positions, effectively you're paying a higher capital gains tax too of 20%. So really, to sell or not sell also is a big question, because should you book a gain, which is at 20%, because many of these scripts have also gone up. So it's going to impact the market.
So, Deepak, come in on this. I think the numbers Mr. Relly has given us. The question is, does it curb speculation? It's a big hike. He's put out the numbers, 21% to 31% on options. The tax itself has gone up by 60%. Does it curb speculation?
No, I think the problem with speculation is not the people who pay 1 crore in premium. They are relatively small in numbers. So take a person who pays 1 lakh rupees in premium, which is probably still the higher end of the speculatory. Speculation is not bad. It is this unbridled gambling that is bad. And a lot of people look at speculation as gambling, but it's not. In the stock market, there is difference between a casino and the stock market. Is the stock market, the house does not take all the winnings. The winnings are, you can be a winner regardless. In a casino, if you win consistently, they throw you out. In the market, you can win consistently and continue to exist and be there. The problem with speculation is usually the small person who does not have too much money leverages themselves by taking a loan and then leverages themselves in the market as well. So on 1 lakh, the difference is maybe 30 rupees. Now, for a lot of people, this 30 rupees is not meaningfully different, or maybe I don't know if it's 30 or 300. I think it's 30 rupees. But the actual numbers is not so meaningful that people will get deterred by STT or by a larger capital gains tax, because if they were making profits, then they would be worry. But then the problem, as stated, is that the speculation is bad only because a lot of people lose money. If they're losing money, they're not paying taxes on that money at all. But I think the STT itself is not meaningful. It will hurt non-speculatory activities, such as even arbitrage funds, who will see a 20 to 25 basis point decrease in their yields simply because of the higher STT on futures. But the options piece, I don't think it will curb speculation meaningfully. It's just, there's a lot of money being made in options, a lot of, transactions happening in options. The government's like, if you guys are willing to pay, I might as well charge a little bit more, and let's see where you stop playing this game.
It's the golden goose, right? Laying golden eggs right now. Dheeraj, come in, your view. In absolute numbers, it doesn't appear to be significant, though in percentage terms, it does look like a very significant increase. Will it curb speculation?
So Deepak is absolutely right. Even if we do the math on a 1 lakh option premium, the current cost is government charges are 90 rupees and it will move to 27. So it's almost an increase of 30 rupees only, 37 rupees what Deepak has mentioned. See, you have to take this into account that these transactions are done on a wafer thin margin only. So to that extent, it will have its own impact. It's not just a sentiment impact, it's also the real math, real gain or loss impact for the investors. And if you look at the overall F&O volume, 50% of the volume is done by the prop traders as well as arbitragers. So particularly they operate at a wafer thin margins. So to that extent, when their impact cost will increase, the transaction cost will increase, there we will see the impact of the volume. And I also echo the sentiments expressed by Girish. It's not just the impact of the transaction cost attributed to the securities transaction tax, but also the overall action taken by the regulators also. And there are more action on the anvil. we will see that there will be more actions coming in the forms of some more radical changes in whether how many expiries per exchange can be there, or maybe a lot size can also go up. So if you, it's the culmination of entire impact. I think that will definitely address the speculative activities in the FNO space.
Okay, got that. So let's see. Maybe this is not the end of it. This is just from the tax perspective. Let's see what SEBI now, what prescriptions SEBI finally prescribes. Gentlemen, let's move to the next issue, which is buyback tax. That got a whole lot of debate going yesterday as well. Now, first of all, let's get clarity from Girish. Girish, the interpretation that I got was it's very simple. The arbitrage between dividends and buybacks goes away. Dividends were being taxed in the hands of the recipient at the slab rate. And now the same will happen for buybacks. Tell us if that's right. And I think the price of the share, that can be taken as a capital loss, which you set off against a capital gain. But basically, is there any arbitrage left at all?
Actually, I want to twist this. Clearly, if you look at it purely as dividends and buyback tax, which is 20% versus a dividend tax of 35%, you can say the arbitrage has gone away. But if you put a treaty into play, let's say foreign companies investing through Singapore or Mauritius or directly through Netherlands, UK, the answers may be different. Actually, they'll come under dividend taxes. In Mauritius, the dividend tax rate is 5%. In Netherlands, it's 10%. You may have a better answer to yourself. Then you twist it even further. You look at open market purchases for buyback. You look at tender offers in buyback. Tender offer in buyback, I understand the law is very simple. Now it will be taxed in the hands of the respective shareholder at his rate. But look at open market purchases. If you do open market purchases, you will sell on the stock market paying STT. You don't know when the company is gradually buying. And when you pay STT, you'll pay 12.5% depending upon long-term, short-term. And then the company will also argue no taxes. So if you were doing open market purchases, can you actually say there is no tax on buyback now? Because you'll anyway pay the lower amount of capital gains tax. And to the company, there is no buyback tax. So really, this whole section needs to think. Other queries which I'm getting today and yesterday is that what about buyback announced? At what point of time will this be applicable? The law says it's applicable effective October 1, 2024. Now, one is the announcement of buyback, board resolution for buyback, shareholder resolution for buyback, if applicable, opening of the tender offer. At what point of time do we have to look at October 1? What happens to shares tendered before October 1? It's clearly under the old law. Shares tendered after October 1, after the, it's as per the new law. Yeah. What does tendering means? Tendering means what is the point of time? It's the point of time when the company accepts the buyback.
No, fair enough. Girish, just to clarify, making it very simple for viewers who are watching, as per the new law, as per now the way things stand, when there is a buyback that's happening through the market route and I'm tendering in my shares, first of all, I have to pay STT on that trade. I'll have to pay capital gains, which is long-term or short-term. And then when the company eventually gives the income back to me, which is now going to be dividend income, then I have to pay tax at my slab rate, right? So that's 3 taxes.
No, so when you offer it for buyback, when you give it in your tender process, there is no tax because you're tendering the shares to your company. So there is no tax on that point of time. When you get the money, when the company accepts your tender and gives you the money, at that point of time, you pay dividend tax. And afterwards, because you have tendered your shares and got money and paid dividend tax, there's a capital loss in your hand, which you can set off. So at the time of offering to tender, there is no tax. When you get the money, there is tax.
Got it. And that will be at your slab rate. Deepak, this entire buyback is a critical issue for IT companies because they annually give you a buyback and most of the large cap IT companies have very high promoter holding. So give us your take on this entire buyback versus dividend.
So Rima, nobody's going to do a buyback anymore. I think that's just very clear. I would, as a promoter, absolutely not do it. The only people who benefit from buybacks now are mutual funds. And insurance companies or pension funds and so on who are not who don't pay tax, right? So if I was the promoter of a company and I had to pay, I had to participate in a buyback, I would have to pay a certain amount of money to buy back my shares. From April 1, by the way, there's no open market buybacks allowed at all. The buyback regulations have changed to only allow tender buybacks after April 2025. Right now, there's a small window till then. But then, the buyback concept was, instead of paying a dividend, I'll do a buyback, and then the cost is roughly the same. The company pays the tax of 20%, and people get it tax-free in their hands, which is actually worthwhile for a lot of promoters to be able to take money, whether it's a TCS, the Tata, and by the way, we have a holding there. But TCS gets a significant amount of its money from TCS. Tata Sons gets its money from TCS in the form of dividends and buybacks. But why will they take money, pay 39% on it, and have this large amount of money lying around as a capital loss, which may not even be a large amount of money, simply because they might have bought the shares at a much lower price. Yeah. So
on the whole,
how do you repatriate income? If you have to do either dividends or buyback, so what will companies do?
Dividends. Why not?
Dividends. Okay.
It's a lesser problem.
So if earlier, suppose a company was doing 1,000 rupees worth of buyback, now the amount that they will give, considering all the taxation, will be lower than 1,000. Because one reason for buying IT companies was also the kind of return that they give back in the form of dividend or buyback. So will that be lower?
I think it will be 1,200, because if they did a buyback at 1,000 crores, they had to pay 200 crores as tax separately, right? So they were actually distributing 1,200 crores. 200 was going to the government. Okay. Now they have 1,200 to distribute. They will distribute the whole 1,200 as a dividend and leave it for you to pay the taxes.
Okay, all right. We have to pay the taxes. That's the bottom line. Come what may, and whichever format they might take. Gentlemen, thank you very much. We're out of time, but definitely not out of questions. These are complex issues, and I think we'll have more of these conversations to get further clarity. Thank you very much, Mr. Relly, Girish, Deepak, for joining in and demystifying some of these taxation points for our viewers. Right now, take a very quick break. We'll come back with a lot more on the other side, including several stocks that are in focus today.
Commitments in Andhra Pradesh Reorganization Act. Recognizing the state's need for the capital, recognizing the state's need for a capital, we will facilitate special financial support through multilateral development agencies. In the current financial year, 15,000 crore rupees will be arranged with additional amounts in future years. Our government is fully committed to financing and early completion of the Polavaram irrigation project, which is the lifeline for Andhra Pradesh and its farmers. This will facilitate our country's food security as well. Under the Act, Andhra Pradesh Reorganization Act, for promoting industrial development, funds will be provided for essential infrastructure such as water, power, railways, and roads. In Kopparthi node on the Visakhapatnam-Chennai Industrial Corridor and Varavakal node on the Hyderabad-Bengaluru Industrial Corridor. Government will implement following 3 schemes for employment.
Welcome back. Banks take center stage, and today Federal Bank will be reporting numbers. Abhishek joins in with the key expectations. Abhishek.
This will be the 56th and last board meeting that Mr. Shyam Srinivasan will attend for Federal Bank's quarterly numbers. So take a look. Our poll suggests that the growth will be healthy. They have already given a business update. Net interest margin is expected to remain flat on a sequential basis at 3.2%. Now, analysts are pegging the slippages to be in the range of 450 to 550 crore. Seasonal in nature, that Q1 slippages do spike up versus Q4. However, asset quality can remain stable. Motilal Oswal expects gross NPA ratio at 2.1%, which is the same that was there in previous quarter as well. Operating profit growth is seen at close to 11% YOY and 30.2% quarter-on-quarter as per Kotak Securities. Focus will be on commentary that the management gives with respect to outlook of the bank in the near future. Our poll suggests NII growth of 19% YOY and 4% sequentially. We are working with a profit growth of 10.8% YOY and about 4.5% sequentially. Thank you.
All right, Abhishek, thank you very much for that. And with that, move on. MSCI is slated for a review next month. Vivek is joining in with a list of the likely inclusions. Vivek.
Well, good afternoon. That's right. So the reason we are highlighting, this particular development today is the fact that sometime in the course of the last week and in the first two trading sessions that we have witnessed of this particular week would have been the cutoff date for MSCI to go ahead and consider the likely inclusions and exclusions of stocks into the MSCI August, potential review. So when is the announcement expected? The MSCI announcement is expected on 13th of August, and the actual adjustment will take place on 30th of August. So, it's expected to be, net inflow event as far as India is concerned. As per IIFL, there are almost 7 stocks that could make the cut and enter the MSCI, index this time around. First on the list, Zydus Life, expect inflows of close to $184 million. Prestige Estates, close to 160. Dixon Tech, 237. OFSS, around $150 million. Oil India, around $178 million. Vodafone Idea could make the cut this time around. Almost $275 million of inflows could be seen over there. RVNL2 could make the cut. Now, one very important development that is likely to happen this time around is the likely weight increase of HDFC Bank. Remember, HDFC Bank in its shareholding pattern indicated that there is now enough foreign headroom for MSCI to go and double up its weightage. So IIFL estimates almost $2.7 billion of inflows could be seen over there. Now, apart from the August review, there is also a smaller event today. Indus Tower that saw a block deal happen, 1 month ago, where Vodafone, went ahead and pared its stake. On the back of that, there was increased free float, and today there will be a weight increase, in the MSCI index itself. Around $140 million of inflows expected in the last hour of trade today, which works out to around 2 times the average daily traded volume. Important development. We'll keep an eye out for, when the actual, MSCI review does come out.
Thank you very much for that. Get into a break. We'll come back with more on the markets and commodities. Stay tuned.
Incentive as part of the Prime Minister's package. These will be based on enrollment in the EPFO and focus on recognition of first-time employees and support to employees and employers. Scheme A, first-timers. This scheme will provide 1 month wage to all persons newly entering the workforce in all formal sectors. Direct benefit transfer of 1 month's salary in 3 installments to first-time employees as registered in the EPFO will be up to 15,000 rupees. The eligibility limit will be a salary of 1 lakh per month. The scheme is expected to benefit 210 lakh youths. Scheme B, job creation in manufacturing. This scheme will incentivize additional employment in the manufacturing sector linked to the employment of first-time employees. An incentive will be provided at specified scale directly both to the employee and the employer with respect to the EPFO contribution in the first 4 years of employment. The scheme is expected to benefit 30 lakh youth entering employment and their employers. Scheme C, support to employers. All additional employment within a salary of 1 lakh rupee per month will be counted. The government will reimburse to employers up to 3,000 rupees per month for 2 years towards the EPFO contribution for each additional employee. The scheme is expected to
Welcome back. Let's now talk commodities. We have Manisha joining in and she's focusing on copper today. Manisha.
Well, I'm looking at metals as a sector which has seen constant declines for the previous week, and this week doesn't seem to be auguring any well. I'll focus on copper, where the prices have now declined to near 4-month lows. From an all-time high of $11,000 a ton in the month of May, we seem to be near around $9,200 a ton at this point in time. Well, there are demand concerns from China. It has been weaker economic data. The first quarter GDP numbers were also on the weaker side. And then there are the third plenum meeting in China also has ended without any addressing any economic challenges there. The US also is expected to hike tariffs against Chinese goods, and that is weighing onto the prices there. And then the US home sales have seen a decline, the steepest one in last couple of years. The July factory orders from Japan also have come in on the weaker side, below 50. So everywhere that you look, the economic data has been weaker. The Chinese manufacturing and services data, now that comes in the next week, is something that the street will keep an eye on. There is some positive cues, especially in Asia, when it comes to India, where after the budget, the expectation is that India could be looking at spending more on infrastructure, and that would lead to metal demand coming higher. But if you look at the LME and the China inventories, they are the highest in since May 2023, and there is a discount if you want to buy copper and various other metals right now, and that tells you about the recent trend in prices. When you look at the metal prices in last 1 week, we have seen a decline across board here. Copper has declined by 6.5% in 1 week itself. We have zinc down by 6%. Aluminum, nickel, lead also have declined anywhere between 4 to 5%. And you have tin, which has declined by 10% in the matter of last 1 week itself. So unless you get stronger data coming in from China or the rest of the consuming world, the expectation is that you could look at this pressure continuing for metals.
Thank you very much for that. And with that, it's a wrap on Trading Hour. Hope you enjoyed the show. Stay tuned. Halftime Report is up next.
additional employment of 50 lakh persons.
I'm endorsing Vice President Kamala Harris because she's ready to step up, bring our party together, go toe-to-toe with Donald Trump, and win in November.
Kamala Harris is at the top of my list. I know her well from having worked with her in the Senate, on the Judiciary Committee, sitting next to her on the floor of the Senate, knowing her and her family personally.
I think Vice President Harris's energy, her enthusiasm, the time she spent here connecting with Pennsylvanians, she's no stranger to us. She spent a lot of time here. I think people will be ready to enthusiastically support her.
Hindustan Unilever performs a tad better than expectations with inline volume growth, but the stock slipped on likely profit taking after a recent run-up. Bajaj Finance sees healthy income growth, but margins crimp and credit cost spikes, leading to a dip in the stock on concerns on asset quality rise. While the Finance Secretary suggests withdrawal of indexation along with a tax cut should be positive, some in industry differ. The impact is expected to be positive for some, but negative for others. Hello and welcome to Halftime Report on CNBC TV 18. I'm Ekta Batra, and it's turning out to be a session where we are seeing some amount of mid-cap outperformance, which is really taking place in today's trading session. So that seems to be the key point for today, that yes, there is sentiment which is soured after the LTCG as well as the short-term capital gains tax.